Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's April 12th, 2019, episode 23. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week.
This show is broadcast as both an audio podcast and as a video on YouTube. So if you're enjoying this as a podcast and you feel like you're missing out on the charts or videos we're referencing, you can register at the markethuddle.com website to get your weekly email, which includes the chart pack and video links, or just flip over to YouTube.
In this week's episode, we're thankful to be joined by Chase Taylor, author of the Pinecone Macro Letter.
And then we're going to afterwards debate who is right, Mr. Bond Market or Mr. Stock Market.
In our This Week in Trading History, we remember back to the advent of Procter & Gamble.
And then we're going to end with the top 5 most important things to watch next week. So let's jump into it.
Chase, thanks a lot for joining us this week. It's a pleasure to have you.
Yeah, it's great to be here, guys. I listen every week, so it's really nice to join you all.
Well, thanks for joining us. So, yeah, but what we're going to do here is we're going to get into the beer of the week. So, Kev, who's the sponsor this week?
Well, this week our sponsor is Bell City Brewing, and it's the Real McCoy, the craft lager. Let's open it up and have a taste, and then I'm going to tell you a little bit about the beer.
All right. Oh, my God, this foamed all over me. Wow.
Oh, that's actually quite nice. So, Patrick
Yeah.
and Chase as well,
Yeah.
I was looking up the history of the beer. Well, actually, on the promotional pamphlet package they sent us with the with the sponsorship, it was included. But do you have any idea why? First of all, Bell City Brewing is actually from Brantford, Ontario. It's a small town outside of Toronto. And I always know Brantford as the home of Wayne Gretzky.
That's right.
That's
right.
So
the greatest hockey player ever.
Really? You think so?
Well,
like, honestly, you take that, like, I don't know, Bobby Orr was pretty good.
Okay.
So anyways, as usual, Patrick, you and I can't agree. So anyways, I was looking at this, and I didn't realize it, but it's named Bell City Brewing because Brantford is called Bell City because they have another famous resident, and it's Alexander Graham Bell. Wow. I had no idea that he lived there. He was originally Scottish, but he actually lived in Brantford.
That's
so
crazy.
There you go.
Well, that's a little bit from the history books there. So
there you go.
Well, we have to ask Chase, what are you drinking?
So I'm drinking a Habitus double IPA out of Mike Hess Brewing. They're from San Diego. It's a 8%, nice 8%. Little double IPA. Yeah. It's a great brewery. If you guys are ever in San Diego, go check out the brew pub.
Yeah. Oh, that sounds awesome. But that's at 8%. You just need to have like 3 of those, and you're going to be having a great time.
Indeed. Chase, my original goal was to break Tony Greer's record today, but I got to go somewhere after this, so I don't know. Maybe I'll only tie it.
Chase, I don't know. Is that considered sessionable? Like, is that beer, is that sessionable, which we just learned. Now, Chase is a millennial, so he actually probably understands what that is. But we just realized the other day that sessionable, when the millennials describe a beer as sessionable, it means that you can drink lots of them.
So I don't think it is. And the way I view IPAs is double is better than single and triple is better than double. And that's kind of my metric.
Okay, sounds good. Now, I have to do my legal stuff, so I'm going to go ahead and do that while you guys are enjoying your beers. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include Scoptic syndrome. Now, I want everyone to go look that up. Cotard's delusion or collywobbles. Please see a doctor if any of these conditions persist, and if so, Flintstones chewable morphine tablets might be right for your family.
All right. Thanks, Kev. We needed to get that disclaimer in there. It's time to move on. First of all, we always start the show asking our guest, Chase, in this case, to tell us about what's on your mind and what's the most pressing thing or the important thing that you're watching. And so, first of all, Chase, if anyone wants to follow you, they can follow you at Pinecone Macro on Twitter, right?
Absolutely.
Yeah. So, and you write a great blog. Letter. We'll talk about that a little bit later on. But what is on your mind? What did you want to talk about?
So I kind of noticed this week that, first of all, I was a giant bond bear, kind of like Kev there for a while, for really about 2 years, and I flipped last fall. The biggest reason I flipped was because oil just respected none of my squiggles and just cut through it like hot butter and stopped me out on the way down. And between that and stocks just cratering, I kind of realized something was different in the economy. So that's when I started thinking we're going to see some deflation and bond yields get lower, and got long bonds. And actually about a week and a half, 2 weeks ago, I got out of those long bond trades. They kind of just hit some technical levels that looked like we get a bounce, and now we are getting a bounce, maybe even kind of bigger than I expected. So, and on the same exact things happening, but opposite, where stocks and oil have flown through levels that I thought would slow them down at least.
Yeah,
so
that's been crazy. Like just unbelievable V shape on that oil chart. Just yeah, when I listen to Art Berman and others talking about the structural shift in the oil market, suddenly oil's like a stone's throw away from the ranges it collapsed from. It's unbelievable.
Yeah, oil kind of is right around that 61.8 retrace right now, but you actually look at gasoline futures and they're well ahead of, they're near the actual where they started.
Yeah.
So that just got me looking, okay, like maybe we're going to start seeing some inflation again. So I just kind of started digging around and did find some areas. And one of the things I looked at was, as you have up here now, the 30-year yield. As I think we all know, we broke out of the downtrend line that's been going on since about the time I was born. But since yields have collapsed back down, they've actually tested the top of that trend line and are now bouncing higher. So I just found that pretty interesting. If you go on to the next slide there, I'll kind of talk about it. German bond yields are kind of popping higher, especially this week. And the data that came out of China was showing, most of their data is kind of picking up a little bit. M1 finally looks like it's bottoming and trying to get off the floor. So the fact that bond yields are kind of following some of that Chinese data, so just starting to look like the whole world is seeing a little bit of reflation. And I don't think China's going to do what they did a few years ago. I don't think it's going to be a giant stimulus that pumps everything again, but I do think it might be enough to kind of keep inflation a little higher than folks expect, especially in the U.S. with where labor markets are.
Well, there's no denying in my mind that inflation has just picked up a little bit. But do you believe that this is just a short-term kind of a counter reaction to an overshoot, or do you believe that this could develop into a bigger trend where inflation comes back with a little bit more muscle?
I think kind of in between. I don't think we're going to get some big spike or anything. I still think the economy's going to keep weakening into the second half, so it's going to make it kind of tough. I just think it's going to stay higher than people expect, mostly for the rest of the year. And nothing crazy, but enough to throw people off.
Right.
So I thought for a second there, Chase, you were going to be completely in my camp, and you were going to tell Patrick that all his deflationary nonsense was exactly that, and nonsense.
That just means that he's a smart guy.
Yeah. So I think it's just you guys hedging your bets. You don't want to come out and just say it's headed lower.
But, I actually think it's headed lower. But
you think that you're trying to be respectful of our guest? I take it. One of the things that I just want to kind of point out is that as we go throughout the year, and you look at the year over year, energy is the biggest kind of input into inflation. And as we approach the latter half of this year, we're going to be comparing against points of inflation, of crude oil prices that were $45, $50. And so I completely agree with you, Chase, that we're going to be surprised at the fact that come later in the second half and especially in that last quarter, if all that has to happen is crude oil has to not go down, and the amount of pickup in CPI is going to be huge. It's going to catch everyone off guard.
Yeah,
and,
absolutely.
Sorry, go ahead.
No, I was going to say a couple charts forward. I have a chart of gasoline futures, and it's a monthly, and then I kind of superimposed the CPI on it. It's definitely chart crime because they don't match up perfect, but it does still show you like kind of where we've been with CPI and gasoline, and the fact that gasoline is now just ripped higher, and I think it will be a big input in pulling inflation higher in the months to come.
And so I have a question for you. We've seen a big shift from Powell. There's no doubt that he flip-flopped. And the question I have for you is, do you think that it was a mistake in raising rates to the point where he did, and he caused the economy to stutter to a point where we can't pull out of it? Or do you think the mistake is now in that he's allowing kind of rates to go back down and he's not continuing with that hiking path?
I think it's fair to say December was a mistake. It's at that point, oil and stocks are both falling off a cliff, and a lot of leading indicators were looking terrible. And not only did he, hike in December, but he did it, really strongly, and said, I always say, he told us we could take QT from his cold dead hands that day. And then, well, I guess his hands are pretty cold
Charlton
now.
Heston, right? Yeah, right.
Yeah. So I think how forceful he was in December, and the fact that he did hike in December, that may have been a mistake. And I know a lot of people have been, upset with the reaction since and the fact that he's capitulated. But I think, to be fair to him, like all the data is pretty much, supported the Fed, going easy since. So I'd say December was a mistake. What he's done since might be a mistake in the long run from the, standpoint that financial stability could become an issue again, something that he at least pretended to care about for a long time. And the Fed did talk about it this week, so it might be back on the radar, and maybe that's why we're kind of seeing a Fed caller instead of a Fed put up here. But
is anybody going to believe him if he comes out and tries to talk the market down? I think that they're just going to laugh at him. I think that he's lost all credibility, and that ultimately if he tries to go and if he gets worried about financial conditions being too loose, that he has become impotent for actually tamping those down.
Yeah. When you add to the fact they're talking about symmetrical inflation now, if we do see inflation stay higher than a lot of us or a lot of people, market participants, think in the months ahead, that's kind of he's going to get put to the test big time. And I think you're right. I think if he starts talking tough, people, I don't think hikes are going to get priced in no matter how hard they try, at least early on.
That's right. So now I saw in one of your charts that how would you play this? So if we expect an uptick of inflation and you see that we're going to second half that this is going to occur, what would you do? Like, how do you position yourself? How do you take advantage of it?
So because I do think the economy is going to keep weakening, but inflation could be a little stubborn, I think tips are something that are a solid option. And the tip ETF, it has been doing well lately and is actually kind of hitting its head on a downtrend line, a horizontal area of resistance, and it's like right at the 200 week. So there's three kind of clustered areas that are important technically that it could break out of here shortly. So if it does break out of that, then that tells me, I may be right about we're going to slow, but we're going to see inflation, be stickier than everyone thinks. And then I think tips could be a good place to hide for a few months. And
okay, and then
also if you look at
have
tips
another
versus,
one. That's right. Yeah. You have the RINF, right?
Yeah, and that's another one you could use. And the inflation expectations ETF, which you've talked about before, it's kind of scary because it kind of looks like it could be a bear flag, but again, it's worth watching, and it's something that's similar to tips, where if inflation expectations do go higher, then that ETF will perform well. But you're going to get the same action in tips because they kind of move on inflation expectations. So, and when you chart,
that's I'm going to pine in here because to me, I completely understand the argument that energy is the biggest input into inflation expectations. And when we have this magnitude of a rise in gasoline and oil prices, that it has to result in some sort of an uptick in inflation numbers, right? And so we're going to see. I think we just had a hot PPI number print, and it's certainly going to cause some cost push inflation to come in, but through history on a much bigger scale, in order for there to be a sustained rise in inflation, you need to make the argument that there's going to be some material increase in money supply, and that somehow, either whether through a credit surge or through some money thing. And so while yes, there's no denying that there will be higher short-term inflation, but to me, and you guys can rip into me all you want on this, but until I see someone make me an argument that we're about to see a big surge in money creation that could drive sustained inflation, then this is just going to be faded. I think this is just an opportunity that if they create a pop in this inflation expectations because of the short-term little surge, I'll be shorting that all day long.
Chase, you go ahead. You tell Patrick why he's wrong.
Yeah, well, I mean, you guys have talked about MMT a lot, and I think we all kind of see that as an inevitability. So, of course, if you're looking for something to really anchor those inflation expectations higher, I think.
Okay, but that's pretty big picture. The MMT is not coming in later this year. So if we're going out 3 to 5 years and past the next presidential cycles and all that stuff, then maybe. But I mean, what are the drivers this year and next year that could drive sustained inflation other than this short-term uptick in commodities, which is definitely going to happen?
Yeah, I mean, we just saw Nancy Pelosi talking about $2 trillion infrastructure. So I think that could end up being a catalyst if, and I know there's a lot of debate
well,
around
that's catalyst for economic activity, but not necessarily, that may not necessarily result in inflation. But anyway.
Patrick, 1 second. No, Patrick.
Oh, my God.
Sorry, go ahead, Chase. I'll let you go ahead. Chase, you rip into him. Go, bud.
No, I was just going to say, I mean, if the economy is going to weaken and we get an inflation, or an infrastructure bill into a weakening economy, I wouldn't doubt at all the Fed, back that up by doing some more QE. Even if they don't lower rates much, I could see them doing new QE.
Okay. And not only that, Patrick, we're going to go into a $2 trillion infrastructure with unemployment or employment as tight as it's been in ages. I think that.
Oh my God! Are you suddenly after wage inflation has not appeared here in years, suddenly you're going back into this whole thing that we're about to have a surge in wage inflation? Is that what you're trying to imply?
We'll pick this another time when we don't have a guest that actually wants to talk about this. But I think the other thing that you should realize is that Brent Johnson from Santiago Capital has a great chart where he goes through and shows how the fiscal stimulus that everybody thinks petered out in 2018 is actually still alive and well and hit its peak point, I believe, kind of mid-2019, not 2018. Now, there's some debate about how that's measured and everything like that, but we're still in a period where the Federal Reserve has taken its foot off the brake and the fiscal side is still pedal to the metal. So you're sitting around and you're looking at prices of oil going up, gasoline going up, and saying, oh, no, you guys are wrong. These are all about to go lower. There's no inflation. And meanwhile, I think it's happening all around you.
But it's not. If you look at the long
term. Let's let Chase talk.
All right.
Let's let Chase talk.
So Chase, what chart do you want to go to next year? What's.
There's a chart in there that kind of has 4 different charts showing some inflation data. You can pull that up.
Yeah.
And one thing I will say about what you guys were just saying, that wage inflation isn't here, but I feel like if 5-6 years ago you said, wage inflation was going to be over 3 and unemployment was going to be where it is, you would have thought of that as pretty inflationary. So it's not 0, that's for sure. For sure. So this just has some different research from. So one thing, the UIG that the New York Fed uses, if you look at the chart there, it is stayed way higher than CPI. CPI is kind of cyclically falling apart, but especially the full data set measure that the New York Fed uses is still stayed pretty high. It's around 3%. The Atlanta
Chase,
Fed
why don't you explain to our listeners what UIG is?
So UIG is just something is for underlying inflation gauge. So the New York Fed creates it by sort of broadening out everything that they're measuring so that it doesn't, it's not as quite as narrowly focused as other inflation measures that are typically used. And a lot of folks in the Fed prefer using UIG to regular CPI. So I don't think it's insignificant.
That's right. I believe it's less jumpy, right? It doesn't move up and down as much, right?
Well, you can see that on the chart.
Definitely.
That it's far more stable.
They charted against CPI where it doesn't move as much. And hey, maybe it is about to follow CPI down, but I think it's significant that it has stayed near its highs. And another thing is, like we talked about energy, but healthcare, housing have all been driving a good bit of inflation as well, especially the rent prices. And I know Goldman Sachs is showing where they think that this keeps marching higher, that and healthcare. So it's not just energy that just makes the base effects kind of pop.
Right. So I have to ask you though, going back one slide here, just on the Aussie, what's your thinking here on the Aussie dollar? Because I know one person that happens to be very bearish the Aussie, particularly against the CAD, and so what do you see here with the Aussie that's on your mind?
So I put it in here just because if you think you're going to get inflation, especially globally, you would expect the Aussie to start doing well, and it's kind of popped recently, especially with this week with the Chinese data. I've been an Aussie bear for a long time, really big bear, and I'm kind of in Kev's.
It's too much tourist on your mind, but
I mean, it is breaking out of its little downtrend. But I think I have a horizontal kind of line drawn that's not much further, and if we get above that, then I'm just wrong for a little bit at least. So I'm still overall bearish the Aussie, but I'm taking seriously the fact that it's showing me that the reflation out of China could start moving markets.
Yeah, actually, I'm in the camp as well, so I don't want to kind of try to play the other side here. But I'm like you. At least I'm the impression I'm like you, because I'm much more interested in the Aussie against the U.S. dollar versus Kev's much more of the Aussie CAD kind of guy. But I personally think that even if there is a short-term pop, that there just isn't the backdrop for a sustained rally in the Aussie. I think this is just a gift to go short again.
I agree.
Yeah. Kev, you have any opinion on that?
Well, I'm kind of torn on that one. I'll just go back to I like it against CAD. So or I hate it against CAD because that's my trade on that. And a lot of the times the short-term squiggles, as you get news out of China moving it one way or another, it affects it. But longer term, I think the Australian dollar is going to, the Australian economy is going to underperform Canada's. And I go back to the fact that who's their biggest trading partner is China. I think China is going to underperform the U.S. Who's Canada's biggest trading partner is the U.S. Now, Chase, I noticed that you had a chart of the TIPS versus the TLT. Why don't you tell us what's on your mind there? And in some extent, isn't that just the RINF? Isn't that what we're looking at when you're pulling that up? Meaning that when you're looking at one versus the other, it is in essence just the inflation expectations.
Basically, that's what you're getting out of it. I just wanted to show it, because I think a lot of people with the economy slowing down just want to go hide in treasuries, and that makes sense. And it's probably it's been a great trade for a few months. It'll probably continue to be as data continues to weaken, likely. But if maybe a way to get a little extra juice out of being in bonds is to go to TIPS, and it's kind of been building a big rectangle, and it's near the bottom of it and just poking ahead of the 200-week moving average. I just thought if you're going to hide in treasuries, maybe TIPS is a place to do it if you agree that inflation is going to kind of stay pesky for the next few months.
Yeah, so you have a definitely interesting call in that you think the economy is slowing, yet inflation is rising, which is kind of, very unique in that most people would say, yes, inflation's about to take off, but so is the economy, so you can expect rates to go higher. So I would take it that's why, and if you were let's just kind of break it down. If you were expecting that, you should own RINF. And if you're expecting your scenario where you have the economy going lower and like less economic activity and rates kind of drifting lower with it, yet inflation expectations going higher, you should expect tips to outperform the treasuries. Is that correct?
Exactly. That's exactly my thinking.
Yeah.
Yeah.
So that is definitely kind of an unusual call, because usually with the higher economic activity, you expect kind of higher rates. Yet you're arguing that we're going to get lower rates at the same time with more inflation.
Yeah, and I feel like energy has been kind of unique in this cycle, and I think it's sort of offset from what you normally see. Most cycles end with oil near $100, and we're nowhere near that right now. So I could see it getting back up there before the cycle really has to take a turn. And so, but the rest of the economy is kind of struggling as, the sugar high of tax cuts wear off. So to me, it's easy to see the possibility of slowing overall, but having inflation stay kind of hot especially because of energy.
And what would be interesting about that is that would mean real rates would go significantly lower. And that's in essence what you're arguing. And I've always said that the real problem with Powell's policies, that if you looked at like the 2-year tip yield, and let me just pull it up here on my charts, it had gone from, it had been in a huge range for the longest time, and let me just pull it up here 1 second. U.S. tip 2%. So if you look at 2-year tip yields, we had been in a range basically from 50 basis points to negative 200 basis points, meaning that was the real yield. And once Powell came, he pushed those yields out of the range and moved them up from 50 basis points to 200 basis points, meaning that somebody could earn 200 basis points after inflation by giving the government money for 2 years. And what we experienced after that kind of flip-flopping in December with the famous kind of Christmas Eve flip-flop, those have kind of collapsed down to 55 basis points. So I guess what you're saying is that we're back into the range and that's not going up there again. Would that be correct?
Yeah, I think that's fair for at least for a while.
Okay.
All right.
So now, what does this mean for the S&P? Because if we have negative real rates for a while, what are you thinking it means for stocks?
So yeah, interestingly, we're about to challenge the all-time high. So we're about to hit that October where we fell apart in October from far from neutral, as well as like kind of the top of the channel we've been in since 2009. So two significant technical levels that we're about to hit right as rates start to pop a little bit. And if you remember in October, kind of the rate of change of interest rates started getting ugly. Like they started really accelerating higher. We started getting the technical breakouts that everyone was talking about, and a lot of people started getting bearish bonds, not the people that had been for a couple of years. And that's kind of when stocks fell out of bed. So now we're right back about there, and rates are accelerating again. So that rate of change on interest rates could start becoming a problem for the S&P, not to mention further rolling over on data. So I think you're finally getting to a level that looks like you could put on a reasonable short in the S&P and actually have an expectation of doing well.
Nice. That's what I like to hear.
So you're bearish. So you don't think we're about to explode to new highs? And if we do, it's just a chance to sell more.
Well, if we explode to new highs, I'm not sure I'd sell more. But if rates kept going higher too, then I would look for it to break. But I'm definitely not into shorting new all-time highs. That's for sure. But I just think as we test the previous high, there's a good chance
there's
that
asymmetry there because it's either going to fail there or not, right? And so I like the way he thinks there, Kev. He's onto something.
You know what? He talks about fundamentals and then shows me a lot of squiggles.
Yeah, I'm definitely a squiggle guy too. So,
all right,
that's good. The best of both worlds. You're like both of us put together in a much better fashion. Okay, well, thanks for all that. That's right.
All right, let's move on. Chase, at this stage, we always ask our guest for a tale. It's always a tale. We call it tales from the trading desk, but it doesn't always have to be from a trading desk. It could just be a really great story that adds some value, or it's just really funny. So what do you have in store for us?
Yeah, a very sad story for you. This is gonna make it sound like I'm a good VIX trader, and I'm not. I've blown up an account trading VIX ETFs like all too many people. But August 24th, 2015, I'm sure you guys remember that nasty flash crash.
Right.
S&P was down like 1,100, or the Dow was down 1,100. So going into that day, I was actually long the VIX, and obviously that was going great. And I learned a super valuable lesson that day because near the top, I just happened to get lucky, and I was like, this is crazy. I'm going to flip from being long to short vol. And so I'd log in, to my brokerage. I put that order in, market order, mind you, and it just sits there. And it sits there, and it sits there, and it sits there. And I start watching VIX collapse, and they never fill my order. I won't mention the broker, but let's just say they're not my broker anymore. But it was a brutal day. It's probably the only time I really got a VIX trade right and just crushed it. And so my broker just never filled my order the whole day. There was two firms that basically just like shut down on that day because it goes so crazy.
So So you had a market order that did not get filled.
Yep.
You're kidding. That's shocking. Yeah, I had no idea that happened.
I was in UVXY, and you can actually go back and read from that day about a couple firms that had big problems, and luckily for me, I was in one of them. And it cost me just a ton of money because not only was I trying to get out of being long, but I was trying to get short, and vol collapsed down into nothing shortly after. And I would have rang the register well before VIX got to 10 or whatever, but still, it was unfortunate.
Chase, this is a really great story because I have no shortage of members of Big Picture Trading that always ask me to make the call on the VIX and, should I trade this move? And my contention against trading vol through these products and all of these different other derivatives of it is that you're not trading something tangible. You're trading a derivative that is just something that traders trade back and forth, and you just have no certainty of liquidity. And when everyone, I know these fund managers that were going long vol options as a hedge on their portfolios, but one of the biggest problems is that when you go to try to cash in on your hedge, when you think it's supposed to do its job, you may not have the liquidity you believe you deserve to be able to cash in on that. Is that a fair way of describing it?
Yeah, absolutely. And I think a lot of traders have learned very hard lessons with trading vol in the last few years, not, on both sides, going up and down. So it's not something I trade much anymore or at all. Anyone that does use it, it should only be used when you have a really high conviction and really short term. And even then it's dangerous for sure. Unless you're, a Chris Cole and you have some super crazy way of putting it all on, but I don't.
Yeah.
It's funny that the originator of the VIX never thought that it would become a tradable instrument, and he never imagined it to be anywhere near as popular as it was. And I think he's been quoted as saying, "If I knew that, I might not have created it." It's like
Wow.
It's like Einstein, right? It's just kind of got used for the wrong way. So, anyways, that's a great story. Thanks for sharing that with us, Chase.
Mm-hmm.
So Chase, just so if people, at this point we're going to kind of wrap up, but if you want to hear more from Chase, make sure you stay around for the after hours. But before we do that, I just want to thank you and also ask you where people can find and learn more about your service and kind of reach out and get in touch with you.
Yeah, so they can hit me on Twitter at Pinecone Macro, and then my website is pineconemacro.com, and you can find everything you need there.
That's great. I get Chase's letter, and it's a joy to read, and it's even with all the squiggles, because this is Kevin, and I don't like the squiggles as much. It's always good to hear from.
It's funny how you have to clarify that it's Kevin because supposedly
well, that's true.
No one can tell us apart,
and
with our thick Canadian accents.
I met Chase. I met Chase when we were when I was speaking at the Macro Voices live event in Toronto, and and there was a bunch of us that went out, and he was such a quiet, nice, assuming kind of quieter guy, and all these other guys were saying all these things, and then when he spoke, I piped up and listened because I was like, holy smokes, this guy knows what he's talking about, and I suggest everyone go check it out because it's a great letter, and you should all learn a lot from listening or reading it. Thanks again, Chase.
Yeah, thank you guys.
All right, Kev. It's time for us to talk about what we think is the most important event of the week. And really, I saw this great piece from JP Morgan, and it made me ask this important question. Who will be proven right? Will it be the mighty bond market or the stock market? And it was from Nicholas Panagritsoglou. I hope I pronounced that right. But
I'm going to interrupt here. It was from when you were kind of going through with all your bearish buddies on Zero Hedge, right?
Fair enough.
That's right. You found it on Zero Hedge.
I found it on Zero Hedge. I mean, I don't get JP Morgan shit directly, right? So anyway,
okay, go on.
Thanks for the public shaming, but let's move on. So he goes on. He goes that the relative signs of complacency, as he illustrates on that chart, kind of increase the likelihood, or not likelihood, but increase the need to hedge their equity overweight. And what it really comes down to is that he observes that we've now gone down in the U.S. high yield credit market, the junk bond market. They're only pricing in right now a 6% chance of a recession, while the S&P 500 is down to just an 8% chance of a recession, while the bond market implied odds are still over 70% that there's a pending recession coming. And this is a huge divergence in my mind, and I wanted to pick your brain on this in terms of first of all, is this just the data being misinterpreted, or two, which market is getting this wrong? Like, what's going on? Like, because I'm a deflationist. I'm more in the bond market camp. I think that the bond market's right, which a lot of historians have always said the bond market's right, but it doesn't have to be the case this time. What's your thinking on this?
Okay, so the chart's a little complicated, and I do believe that there's a slight mistake. It says USHG credit. I believe he means IG credit, which is investment grade credit. And what you see here is the change from basically April 2nd from January 3rd. Mm-hmm. Okay, so what he's arguing is that the S&P on January 3rd was saying there was a 65% chance of recession, and they've now priced in an 8% chance of recession.
That's a pretty huge reversion.
For sure. And he's saying the same in investment grade credit. It's used to be
high. Was it investment grade? He's talking high yield.
It's saying HG, but I think he means IG. So
no, but there's
one second. Let me go through it. So it's So let's go through it. So it's 55% down to 20%. High yield used to be predicting kind of 30. It's down to 8. Base metals, it used to be predicting 60. It's down to 40. So all of them have kind of reduced the prediction of like the imminent recession.
Yeah. But one market didn't.
Which is the bond market. Now,
which is the 5 years where you trade on your on your.
So I think this is just
widening.
I'm a seller of this chart. I don't think this means anything. The Fed has gone and has staved off kind of an imminent recession through their change in policy. And in doing listen up.
All right.
And in doing so, they have caused a huge bump in risk assets, in investment. They've caused a narrowing in spreads on bonds. They've even caused a base metal rally. Now that might also be a combination of China, but in the meantime, yields have gone lower at various parts of the curve, and especially like the 5-year. So the 5-year is saying the yields have gone lower because there's more of a chance of recession, and therefore that's why the odds have gone up since then. I kind of think, what do you mean? The yields have gone lower because the Fed has changed its policy. Now, if you believe that that yields have gone lower because the Fed changes policies because they're so smart and they know inflation's coming. They know a recession's coming. Then you go for it. You knock yourself out. But the rest of the markets, basically, this model is kind of crap, is what I'm saying. It's basically just looking at it's just looking at previous price movements in the market and saying this is what they're saying about kind of the probability of recession.
Fair enough.
So it's not telling you anything we didn't know. It's telling you yields have gone down and risk assets have gone up. That's all this is telling you.
But is that not a divergence?
No, because that's happening because the Fed has gotten easier.
Yeah.
So I guess it's a divergence if you think that the Fed's gotten easier and they know more than the rest of the risk assets. But I think the market is telling you that they.
But you really believe right now that just by Powell taking his foot off the brake, and just basically that in itself is more than enough to change the business cycle, and now we don't even have to worry about a recession risk. That this is all.
So here, So here's what I believe. I believe that at the very least, it's a possibility, and I'm not going to say
that's a cop out.
No, it's not, because if anybody tells you they know for sure. Whether they tell you they know for sure that we're about to go into deflation.
That's just like a middle of the road call.
No,
it's a possibility.
No. But what I'm telling you is that if you're kind of listening to the market is telling you no. So you of all people, because you believe the market kind of gives signals through its price action. It's kind of ironic that you're that you're saying this price action doesn't mean anything and that you know better.
Well, I do know, but no, just kidding.
But listen. It could be. Listen, I understand the argument. David Rosenberg, very, very he's a very smart guy. He believes the Fed's tightened too much, that we've rolled over. And that there's nothing's going to change. Now, I have one question though for those who believe that it can't be changed and that we're about to enter into a recession. What if the Fed had cut? Would that have been enough to stave off a recession? What if they had cut by 50 or 100? So my point is, at some level, you have to admit the Fed has the power to stave off a recession. Or do you not believe that? Do you believe that the economy is going to roll over no matter what? No matter what the Fed does, the economy was going to roll over.
Maybe naively, I believe in the business cycle, and I believe that there are massive imbalances through a credit expansion that occur. And inevitably, a recession is an incredibly important cleanse within that business cycle where all the misallocated capital gets taken. And so, to me, what I'm really hearing in your statement is the idea that if they move on interest rates, then all the misallocated capital, all the built inventories, all of these different things, that all gets pushed down, and it doesn't matter, as long as interest rates are a little bit lower, that the Fed is able to control all of this with their little magic behind the curtain levers.
Yeah. Okay, so listen, I understand your pushback, and you might not like it, and it might not be the right thing to do, but you have to admit that the Fed has the ability to extend the business cycle. Now
they attempt to extend it.
Okay. So do you think they don't have any ability to extend it?
No. Listen, I don't want to say something naive on the air like that their policy doesn't have an important influence. It does.
Well, that's my point. I don't know if this was enough to extend the business cycle, but I'm keeping my mind open.
What if their reaction is an admittance to the fact that the situation has already turned and that they would only accelerate the problem if they continued to tighten. Like, what if they just have already behind closed doors acknowledged that the crest has already been seen and that we're already over the other side and they are only going to damage things? Like,
okay, so listen, Patrick, I agree that is a possibility.
But you just don't think it's the probable thing.
I think you should keep your mind open to the
listen, as traders, we have a responsibility to keep our mind open.
Right. Okay. But the market is telling you that is not happening. Now, the markets get it wrong, so I'm not trying to say that I believe in the market, because the market gets it wrong all the time. But I'm at least open to the idea that they have extended the business cycle much more so than the bears believe. And I don't know how much easing it'll take. Whether taking their foot off the brake is enough, I don't know. But I'm willing to look and watch and kind of get a feel for it. And the market is telling you, price action is telling you that it looks like it's enough.
All I have to say is that if somehow Trump finishes a 4-year presidential term without and having been able to somehow manage a way to have extended the business cycle that it didn't turn in his 4-year term, I think that would be incredible. I think it would be an incredible feat.
Okay, well, there you go.
And maybe we're in for some incredible.
Yeah. We talked about this before. I believe that we're entering 99, 2000. Or at the very least, you should keep your mind open to that possibility. And
I'll tell you what, I'm going to start drinking your Kool-Aid when we're at 52-week new highs, but not a moment before.
Okay, sounds good. Speaking of drinking, I am getting low on beer. The sponsor didn't send us enough, so let's go on to the next subject.
Let's do that.
I'm going to run out of beer if we don't hurry it up.
There we go. So this week in trading history. And so this week, what I wanted to talk about, just, to change it up a little bit, because I want to get some bigger macro stories in there. But I like these little company stories. But it's not a little company, but I wanted to talk Procter & Gamble. And nice. Procter & Gamble has a really interesting history. And so let's just kind of rewind way back, because it goes back to April of 1837. 1837. And so William Procter, an English candle maker, and James Gamble, which was an Irish soap maker. So we got a candle maker and a soap maker. They ended up opening up shop in Cincinnati, Ohio. And what's interesting is the story of what happened there. So first of all, both men married 2 sisters, so they became like brother-in-laws. And they were trying to make the journey right across west. Who knows? They would have maybe ended up in Seattle or somewhere like that if they successfully completed their journey. But along the way, when they reached Cincinnati, Procter's wife passed away, and James Gamble got very ill, and they both settled down there. And it was like 5-6 months later that they each put in like $3,500, which must be worth hundreds of dollars on an inflation-adjusted basis, to launch Procter & Gamble.
$3,500 was all. Are you sure you got that figure?
Yeah,
$3,500.
$3,596 each they put up to launch the company.
$4 million today.
Probably,
that's
right?
a long time. By the way, before we go any further, which one of them is sporting that wicked beard? Do you know which one's which?
I'm gonna offer a guess that's Gamble, but I risk being wrong. I didn't.
Yeah, and so you know what's interesting about that beard is I'm wondering, as I think about the millennials and their beard, they didn't shave it quite as low as that guy. So I'm wondering how long before that's back in fashion. It's an awful looking beard, and I think that the millennials are going to adopt that before we know it. That's my real prediction for this episode, is that beard is going to come in before we know it, and we're going to be hating it.
Oh, there you go. So what is interesting about this? Okay, I mean, we went back to 1837. So when you look back and you think, what is when you think of the original Dow Jones and the original companies that composed it, what's the first company that comes to mind?
GE.
GE. I was hoping you wouldn't say something different, but General Electric is sort of what I think of when I think of one of the oldest long-standing companies. But GE's inception into the index was 1896 in the original, but it only went public in 1892. I mean, it actually was formed years earlier. But if you think about it, Procter & Gamble was formed like almost 50 years earlier. And now Procter & Gamble not only went public the year before GE went public, so it's an older company from when it went public. The reason why we don't look at it that way is because it was only added to the Dow during the Great Depression in 1932. So GE was in the actual Dow much longer. Well, going back to like 1896 was one of the original entries. But Procter & Gamble actually went public before GE did, and as a company with almost 180 years of history.
Wow, it's unbelievable. You know what's interesting is that you don't realize it, but most companies, their lifespan is quite limited.
Yeah,
and it's very unusual for a company to last that long. And you might say, "Oh, that's not right," and stuff. But I remember seeing a stat, and it's shocking, like how many companies from when we were kids still exist, and it's very, very. You can put it on your hands, kind of deal. And this is unusual that this one lasted so long. It must have been
it's a great story of how they got around. And you know what? I always like to throw Procter & Gamble every once in a while in my portfolio. And it's a great company, and I just thought it was a really interesting this week in trading history.
Well, thanks a lot. Thanks for that story,
Let's move on. So, Kev, it's time for the WTF Clip of the week. Why don't you give us a primer on what's going on here?
Well, Patrick, one of my favorite guys out there, Steve Cottrell, although that's not really his name. It's Steve Eisen, although he's forever going to be Steve Cottrell for me because that's who played him in The Big Short, was out with a great interview about shorting Canadian banks. And
well, you couldn't.
The poor guy, he just gets followed. Like he gets followed with his infamy from The Big Short, and every single time that he shorts anything, he has to kind of go out of his way to say it's not The Big Short. That's all. Like he's going to spend the rest of his life saying it's not The Big Short. It's not The Big Short.
Let's watch it.
Let's watch it and we'll talk about it.
Yeah,
but let's just say he went out of his way to talk about how Canada is not The Big Short and how he really likes the people. So let's give it a whirl.
Okay, let's watch.
Steve Eisen, made famous in the film The Big Short by betting billions against the U.S. housing market prior to the 2008 financial crisis, is now betting against Canada's banks.
Kids, as you know, Aunt Robin grew up in Canada. That meant sometimes she dressed a little differently.
Okay, let's do this.
Sometimes she talked a little differently.
Ted, this hydro bill is bigger than Louis Sir's biceps. What, you leave the carburetor on all night, eh?
She hung out at different bars and enjoyed leisure time a little differently.
Make fun of the Great White North all you want. It's the best country in the world.
Well, I want to start out by saying this is not The Big Short Canada. I don't think the housing market in Canada is going to collapse. I don't think Canada is going to fall into the ocean. What I'm simply calling for is a normalization of credit losses, which Canada hasn't seen in over 20 years. And I think the banks, in terms of their reserves and their balance sheets, are woefully unprepared for that.
Okay.
But, it's not going to be easy, this test. It's not like the Canadian citizenship test.
How do you know the Canadian test is easy?
It's Canada. Question 1, do you want to be Canadian? Question 2, really?
So my view is that at some point this nonsense of negative reserving on stage 1 is going to end, and the loan loss provisions for all the Canadian banks are going to go up considerably.
How many stars are on the flag?
50, one for each state.
What are the first 10 amendments to the Constitution called?
The Bill of Rights. Look, Barney, I know all this. I'm ready.
Ready for the test, maybe. But ready to be an American? Not on your sweet life. For you to be an American, we got to get the Canadian out of you. That's why I've created these questions. Question 1, who is this?
Queen Elizabeth II.
No, the answer is Elton John. Question 2, what the hell is this?
Oh, curling. It's a sport played...
Wrong. The answer we were looking for was, I don't care, it's dumb. Let's go buy something that's bad for us and then sue the people who made it. That's American, Robin.
If they're, in some ways, they're priced for perfection. They're among the most expensive banks on planet Earth on a price to tangible book basis. And they are not nearly as well capitalized as they appear because I think their risk weights are too low.
Attention, Canada. I am Barney from America, and I'm here to fix your backward-ass country. Number 1, get real money. Don't know what board game this came from, but it's a joke.
Now, listen, Canada's a very nice country. The people are extremely polite. This is not personal. But, you know, when some of the Canadian executives say, how could you short our banks? It's a 5% dividend yield. I'm like, listen, I'm not here for 5%.
My friend in Canada who got married way too young, they had to do their vows twice, once in French.
They speak French there, too? God, that place is a mess.
Well, look, I think Canada has not had a credit cycle in a few decades. I don't think there's a Canadian bank CEO that knows what a credit cycle really looks like. And so I just think psychologically, they're extremely ill-prepared. And given how low the risk weights on their balance sheet are, I think they're unprepared for how much their capital ratios could go down if there's just, again, I can't emphasize it enough, just a simple normalization of credit. Not a calamity, just a simple normalization of credit.
So, Steve,
You poor thing. To have to grow up in Canada with America right there.
And Steve, then last question. What got you interested in the Canadian banks? And have you been here? Is there anything else that you're seeing as you do your analysis that strikes you?
I like Canada. And again, it's not personal. I got nothing against them.
Canada, you did it again. You even found a way to ruin this. Why? Why do we let you be a country?
Okay.
It's not like I'm picking on Canada just to single them out.
No.
When I saw him talking about Canada, it just made me think I got to put something in there about Canada and How I Met Your Mother. Actually, I believe the one actress, the lady, I don't know her name, she's a Canadian, and they've had kind of a running gag in there about all the stuff Canada. And I thought, oh, you know what, that'd be a perfect thing. So it was. I enjoyed doing that one because there was a little bit of Canadiana in that, and I enjoyed it tremendously.
No, for sure. So let's talk Canadian banks. But you know what? Before we even get into this, in the defense of Canadian banks, I wanted to just play a quick clip from Victor Dodig. And for those of you that don't know my history, I spent my first 10 years of my career at CIBC in different trading roles and different things like that. And I had the opportunity to meet Victor before he became CEO a number of times throughout that process. So I just thought in the defense of Canadian banks, we should first just give Victor an opportunity to kind of give their thinking. So let's quickly listen to this.
There's been a lot of talk. Everyone's entitled to their own opinion. That's what makes a market. I don't spend a lot of time thinking about it, what people say. I look at the long term. I look at our long-term shareholders, and that's what I'm really focused on. In terms of their own macroeconomic assumptions, everyone's entitled to those as well. I think the economy is in a decent spot right now. Not as good as it was, but in a decent spot. There's a few things to solve for out there. And I think the future for Canada over the short, medium, and longer term is generally a positive one. Yeah, sure, we'll see some bumps in the road, but we'll manage through all of that.
Do you feel as though CIBC's loan losses, your provisions are conservative right now?
I think we provision appropriately for the risk that we see in our business.
You are the bank in this market that's most exposed to the household, to mortgages and HELOCs. rank for that, where that is on your concerns: softening housing market, softening economy.
Look, there's always three risks that anybody that oversees a bank and captains a bank looks at. One is market risk, one is credit risk, and one is operational risk. When you talk about credit risk, I don't see any big issues out there. Sure, we have lent to Canadians for their homes. We feel very comfortable with our portfolio today. It's 38% insured. The rest of it is uninsured. The uninsured component has an LTV, or loan to value, of 54%. There's a margin of safety for everybody.
What would cause you concern? You were actually alone among the banks talking about signs of weakness in the Canadian economy. Is that on the list?
I think we're in a different spot than where we were in the last couple of years. We're at the mature end of the credit cycle. I think everybody will agree with that. I think what's been encouraging is that you don't see inflation right now. You see strong unemployment. You see decent growth. You see some concerns around trade agreements today, and that probably would be my biggest concern.
All right, so Kev, here's the thing. Listen, I've been bearish on the Canadian banks almost as long as Jared Dillon, right? But like,
no, you couldn't have been as bearish as Jared Dillon. There's no way. And not only that, you couldn't have been. Not only from a length of time could you not have been as bearish as Jared Dillon, and from a magnitude. He told. I remember him saying one time that he thought he was going to cover commerce in the single digits. So he is the quintessential.
You know what? I had a great lunch with him when I was out in Myrtle Beach, and you know what? I should have him just come on to the show at some point to kind of give us his thoughts, because he's a good guy.
Yeah, for sure. And not only that, he says all the time that he thinks that he loses all sorts of Canadian subscribers because of his bearish views, and I'm like, it doesn't bother me at all. That's what makes a market. You can be bearish. But Warren Buffett welcomes bears in his stock all the time. He says, it's somebody else that's going to have to buy my stock later. So I'm this, and not only that, I think after his 5 years being bearish, he might be right soon. So not only that, maybe it is time to have him on.
Well, I know we've shared our both of our bearish views on Canadian banks. You've been more the long U.S. banks against the short Canadian bank kind of pairs trade, right? Have you been pairing it, or is that
it's just because I'm scared. I'm just scared about the upside potential of the market taking off. So I'm not a deflationary end of the world kind of guy like you. So I have a little bit of trouble whenever I short stuff outright.
All right, but listen. So here's where we could talk about Steve's view a little bit versus that of the comments that Victor made in that second video clip. But to me, listen, I look at it that management manages their business based upon the credit risks and all of these variables, and to be honest, I don't believe a single Canadian bank has failed at that. Like, I mean, I don't think there's a careless kind of CEO or manager within the bunch that is, let's say, mismanaging the bank. But really what it comes down to is the valuations that the market is giving to the bank, and more importantly, what the valuation will be when the bank can't sustain the current growth trends. Is that a good way of describing it, Kev?
Well, you're probably a little more sympathetic to management. I don't know if Victor's your friend or something, but I think it's very difficult for a manager to get out there and say, we're not going to grow our mortgage book right now, even though everybody else is, because we think that the credit cycle is turned. And inevitably, they have a lot of pressure to keep putting earnings on the tape, and they can't take the risk that that this whole thing takes off without them. And it's just like the .com bubble. Even the bearish guys, they kept doing it because they had to compete with their neighbor. And so I'm not going to give them quite the pass that you're going to give them. But I will say that Steve Eisen, he's not saying this is the end of the world, and he's not saying that they're doing anything dramatically wrong. He's arguing that they're feeling pretty confident going towards the end of a cycle that's been going a long time. it's somewhat reflexive, I would argue, and I think that Steve would say that as well, in that the longer the asset that they're putting onto their balance sheet has been doing well, the less capital that it requires.
Right.
And in that ends up making it more and more profitable with requiring less and less capital. So of course they're doing more, and of course they're going to do too much at the
leverage
end.
up.
Yeah, and I think Steve's just arguing that when it turns, they're going to be surprised.
That's going to mean revert. I think I'm going to just quickly double check on my side screen. But the one thing for instance, just because we just had Victor on the video right here, but I in the last, let's say, 2 decades, there's been at least 3, maybe 4 occasions where CIBC has lost 30, 40, and sometimes 50% of its value just within the business cycle.
So I didn't want to say anything because I am an RBC guy, and so I'm a little partial to the Lion.
I wanted to. I'm short, by the way, RBC. I'm not.
But I
short
wanted to
CIBC.
make a joke. Okay, and I of course never participated in this joke, but. What people on my desk used to call CIBC was the bank that was most likely to walk into a sharp stick. Okay, so they listen. They did really well. They would make more in an up market, and they would lose more in a down market. And I believe that they're trying to change that kind of stereotype or that kind of behavior. But they are definitely more volatile, and that's just kind of always been with the way CIBC is.
Right.
But regardless, I just think that if we step back and take a little bit of a big picture view, Canada is due for a pause. And Steve's bang on correct. And I thought he was very diplomatic when he made his argument, and I thought it was a great thesis, and I agree. And you know what I think is one of the most shocking things? Canada is one of we pay more for our services as Canadians than Americans do, and it's part of the problem is that it's an oligopoly. There's just less competition, and yet we all love our banks. We love them. Like, we just love them, and we all stick them in our portfolios, and everybody loves them. It is one of the most crowded trades out there.
Oh, it is so crowded. It is so crowded.
And you know what's interesting is the other day I was talking to somebody about Australian banks because I think Australian banks are even worse than Canadian banks. Yeah. And someone says, Australians all hate their banks. They can't stand them. And I was like, oh, that's funny. Like, it's actually kind of a cultural thing that's different. They can't stand them.
But I think it's a byproduct from the fact that we have to admit what it is. Canadian banks have been incredibly resilient, and they've created a lot of wealth, and they've been incredibly consistent with their dividends. And so what other impression would human nature offer you?
Oh, I agree. Listen, they've been a great investment. Anybody that's been long has done terrific.
Yeah.
And I just think that Steve might be onto something.
He might be onto something.
It's not just Steve. I actually wrote about the fact that Veritas, which is an independent research firm, very smart guys, and they're kind of a little more Canadian focused, and they actually came out with a negative bank call, and it was like last year. And it was very much centered on the same stats as Steve was highlighting. And as the economy rolls over, and interestingly enough, I was out with some guys the other day from Vancouver, and they were talking about what's happened to real estate there. And I think that there's a good chance that Vancouver real estate has rolled over, and it's rolled over hard, and that we're going to start seeing it in the numbers. And it's not going to be something that's going to be quickly swept under the rug.
I think that what I'll leave everyone with is this. It's not whether or not the banks are going to necessarily have devastating losses, but a lot of what's priced in is growth. And as soon as it just comes to realities that they can't grow their earnings at the pace they can, the multiples are just not going to be able to be defended. And the market is just simply going to mean revert that. I think that that's a reality. Yeah, Vancouver real estate, I don't think they're going to be huge losses on real estate on the bank's balance sheets, but it's about the fact that they won't be able to grow their earnings in this environment. And that's going to be the big issue that's going to create that kind of mean reversion on the bank side. But we'll watch.
Patrick, you hit the nail on the head. You don't need like a 2008 style Big Short for these things to get like a third lopped off.
Well,
all you need is them to have a little bit of increased problems and for their earnings to slow, like to not be able to grow.
And then they can't justify these multiples. They can't. Yeah. That's for certain. This is where it really comes down to. And the other thing, and relative to you, like, okay, would you short, just a quiz question here, would you short the Canadian banks on the NYSE or would you short it on the TSE?
Well, that ends
I have
up
an
being
opinion, but
that ends up being a currency cost.
Yes,
so you might as well just have your opinion on the currency. And
but it's
my
a
trouble
factor,
is
right?
that
because you shared your view. You shared your view. Your view is that much of this will reflect in the Canadian dollar dropping. Is that am I misquoting you?
No, what I argued is that there's no reason of getting like hyperbolic about an end of the world scenario, because if that happens, the Bank of Canada will just let the currency go. And that the reason that the 2008 U.S. Real estate bubble was so bad was because it was in the reserve currency and everyone had borrowed in that currency, and it was it was a reflexive process, and it won't be the same in Canada.
So let me just show you a chart which I think will be a deja vu. I do believe it will be. So this is Royal Bank from 2014 through 2016. On the New York Stock Exchange, because the Canadian dollar wiped out 20% of its value. If you were short Royal Bank on the NYSE, you saw a 40% wipeout on the stock on the downside. But because the Royal Bank, as it trades in Canada, is priced in Canadian dollars, when you go back and look at that same drop in the stock, you basically saw only a 20% wipeout. Obviously, that's the 20% currency difference, right? But
so you're arguing that you should do it in the States.
I
think
so.
Be short over
because a weakening of the Canadian economy, I believe that Bank of Canada is going to let the currency go, and we might. I heard that one. Was it the Fidelity guy that was talking 62-cent Canadian dollar? But
sure.
But anyway, I'm not 62-cent bearish, but I think the Canadian dollar is going lower, and I think that actually on a nominal price basis makes the short on the NYSE the better one, right?
Sounds
like
good, man.
You short the Canadian banks on the New York Stock Exchange, is my opinion. Anyway, so that's enough. So let's move on. Top 5 things to watch next week, Kev.
Okay, before we do that, I think we should talk about last week. And before we review the top 5 things of last week.
No. We're going to talk about that actually when we get into that. Let's first actually just review the top 5 because I have the slide set up that way.
Okay.
So let's just quickly review the top 5 from last week. So we asked the important question last week as to whether the dollar was going to make the big breakout, and the answer is it didn't make the big breakout, did it? And not particularly today after the China data, right?
Right, and not only that, I, like an idiot, stuck my neck out and said that it was going higher, and
and we both agreed. So that means that all of our listeners did the right thing, which was take the opposite side of the trade.
That's right. You know it's not going to happen.
Whenever, for our listeners that don't know this, when me and Kev both agree on a trade, it is a given that you take the opposite side of the trade. It's going to make you big money.
That's right.
And so that means, by the way, both of us are bearish on Canadian banks, so buy now.
That's right. Okay. So the dollar was a non-event, basically. Let's go on.
I still actually think that everything is on course. Look, we're in a consolidation phase. The catalyst for the breakout hasn't happened, but it's still consolidating, and it just certainly hasn't started. So number 4 was Boeing, which was something we both agreed on, and it actually worked. So this is really weird. We basically both last week were talking about that this 400 wasn't going to hold. The stock immediately gaps down to 380. That's the market huddle effect, right?
Yeah, that's right.
the Huddle effect.
And from here, I just think, you know what? It's probably just going to wander around. Like
it's not a screaming short. It's not a screaming short. I just don't think it's going up.
Yeah, no, I agree. It's probably just going to chop around.
It's going to chop. It's going to chop. Yeah. But I mean, it's got to it takes a while. It might even take 6 months for the stock to sort this shit out. And at some point, once all of it is behind the stock, it can move forward, but I don't think it's so. Anyway, any comments on the end of your 530 steepener trade?
Well, not really. It again is just chopping around. I continue to think.
But do you still believe it's the end? Like, do you think that the trade's done? You're out.
I don't
and
think
you're not.
No,
you have no interest in going back in.
No. It's not that I don't like, because ultimately it's like to me the steepener trade is like gold. When I'm like not long, I consider that a short. And I think that it's still going to be the trade of the next decade. I really do.
Really?
Believe that
decade?
Yep.
That's a pretty big fucking call.
Yeah, no, that is my trade of the next decade. But
wow.
It would be just like me to kind of get cute and take it off for a little bit and then watch it take off. But I just don't see a scenario
Lesson to our listeners, don't be cute like Kevin.
Yeah, that's probably, you know what, that is probably the real lesson from this.
But okay. If you have a chance to put it on at 55 or 50 cents, would you do it?
We'll see what it looks like down there, but that is kind of the number I'm looking for. No, I like, that's kind of my, I'd like to see it. And
it's going to mean revert a little bit.
And just more than, like, also price matters, but time matters as well. Yeah, I'm a big believer that when you get something like this, it's gone a long way for a long time. You need just to you can correct either in price.
It's no different than yields got ahead of themselves here in the last 3-4 weeks. It had to mean revert. There's no way there was no way we're going to 2% on the 10-year in one straight line. Yeah. Right? Like it's like I'm a bond bull, but not like that. Like there was that would have been shocking to me. Like
by the way, we have to actually, and if any listeners would be so kind to send us all of our bets, because I know some of them, but some of them I've forgotten. But I do believe that what was
on Twitter, bet? you got it. Well, we're playing the two above below 2. Right, we're.
That's right. It's never going to go. Like it's not going to go.
You don't think it's going back? And I totally am convinced we're going below 2.
Yeah,
I do.
Anyways,
I think
I know you do.
I even though I wouldn't want to make a bet on it, but I would not be shocked if we were even under 1%. But I don't. But that's not a bet that I would make. That's not a bet that I will make. But I would not be shocked if we saw it. I do believe we're clearing 2% on the downside for sure. Our bet is on. I'm gonna enjoy that steak dinner when you buy it for me.
I think that one was just. I don't know.
No, we bet a steak dinner on that one for sure. We did. That was not a Duke and Duke. We've done a lot of Duke and Dukes, but this one's a big deal.
Duke and Duke, but
no, this is a big deal.
I'll honor the steak dinner. That's no problem at all.
Listen, our listeners will let us know. Listen, for our listeners, did we bet the Duke and Duke or did we bet a steak dinner on this one? Let us know on Twitter. Right. This has got to be rectified. We got to write this shit down.
Yeah, we do. We have to do a better job of that.
Okay, anyway, let's move on. So number 2 was the biotech. And so really, what was it, IBX, was it?
No, XBI.
XBI. Jesus, there's my dyslexia kicking in.
Yeah.
All right, so the...
It's okay, you don't actually do anything with letters and numbers for a living, so
never.
It's no problem.
No, I don't. And luckily me. And I was... a little too bullish, maybe.
Well, I think we both were. I look at the chart though; it's still like
this is the problem: is that when both of us agree on something, this is dangerous. But
jury's out. Jury's out, man. You can't convict us yet on that one.
I own a few biotechs, and I haven't pulled the plug on them. I have my protective puts. I've got some hedges in place to give me an out, but I'm not ready to abandon the story yet. But it is not started working. Right. But otherwise, I would have to think that I did anger the gods, have I not? Market gods?
Jesus, did you ever? They were pissed as hell.
I aggravated them. But
and
maybe,
not only that, you made it worse, because then when I pointed out that you were angering the gods, you ridiculed them. And they don't like that.
Was that what I did?
Yeah, you did. And so
my
for
God.
all the bears that are out there wondering why the stock market continues to scream higher, it's Patrick. And I will say,
I think our number one this week may have undid all of my ridiculing.
No. Look today, we're taping this Friday afternoon. We gapped up into new highs for the year.
We did, but wait till we get to our number one this week, and I would think that may very well undo my shame.
Okay, well we'll see when we get there.
All right.
Okay, let's go on then. Let's go on.
So we're going to move on to the top 5 things to watch. Now we have top 5, but there is one I wanted to talk about that did not make our top 5. You were mentioning it earlier, but we had Harris on last week, and what the hell was that?
Yeah, Cuppy has the power of the Cuppy. That's all I can say.
That was unbelievable.
So I'll tell you what that was. Scorpio Tankers.
Yeah.
He's pulling a Forrest Gump.
That day, for no particular reason, I decided to go for a little run.
And so, you just ran.
Yeah.
Run, Forrest, run! Run, Forrest!
It's running like it stole something.
This is the market huddle effect. The stock made it onto our short list. It's like the Kramer effect, and
the Kramer effect. Yeah, it has nothing to do with the fundamentals, and then
it has nothing to do with the fundamentals.
Everything to do with
this
us.
Is about the fact that we like dump. Well, what was for certain. The reason that this was going up in this magnitude was the fact that neither me nor you own any of this.
I know. So when we were doing the tape here, we were trying to figure it out when we were laughing about it. I asked Patrick, I go, did you buy any? He says, no, I didn't buy any. I said, well, there you go. That's why it went up. Neither one of us owned any.
So this thing took off in 1 week, 25%. We released the show on the weekend. Monday morning, the thing advances to $20, and it's north of 24, almost at 25.
The one thing I will say that was kind of funny was that I pulled up on Monday when it was running. I pulled up Bloomberg, and it says Scorpio Tankers reader demand increases, shares rise 3.6%. And it says searching for news about Scorpio Tankers was unusually high, though the number of news stories about the company was no greater than average, i.e. there was no story, but everyone was searching for it, and the thing took off.
The huddle effect, dude. It's the huddle effect. You know what? You know what? We do not.
We're going to goocher it. We're going to goocher
it. We have to goocher it because we need an entry back in. we're out. I hope I goocher this at least 10% back to 22 to give me a shot.
Don't wish that on our guest because we'll come back on.
I would not.
Okay, so on to number 5. Let's go.
All right, so let's move on to number 5. So number 5, Chevron. Has it started an energy boom? What's on your mind here, Kev?
Well, so this morning, Chevron.
Obviously the stock gapped lower because it was the acquirer.
Right, but they announced that they were buying Anadarko.
Yeah,
and so I pull it up on Bloomberg right now, and it says this they a steal in quotes. I just. Let's have a look at the Anadarko. What did its price do? It was up. What is that? How much percent? It's up $15 to $62.
Oh, yeah,
it's
wow.
a big number. So, we're going to talk about this a little bit, and maybe with Chase, but I think that energy stocks.
Yeah, it's up 32% today.
Yeah, energy stocks are cheap. I think some of the majors are figuring it out, and it'll be interesting to see if this is the start of more consolidation and more takeover in the square.
But do you think you think that any of those oil service stocks or the refiners are going to be targeted for this, or?
I know you love the refiners and you love all this.
I'm an opportunist. I don't have a particular bias. I just when I look at what's cheap versus what's that's had a big run already, right? It's
yeah. So I like I would like the service stocks much more than the refiners, but I don't know enough to say anything about it except the fact that I really think that all these things are inexpensive. It's one of the few sectors that hasn't gone. We're getting some M&A. It's exciting, and I think you should keep your eye on it, and that's why we got it in the top 5.
All right, so I'm in agreement with you. Let's watch, and especially if that bull scenario happens on oil. I really am not in the bull camp at all on oil.
No, really?
And
like you've never told us, Patrick. Why don't
I've
you
never
share
said
with us?
that, and our listeners won't hear that in the end of this interview at all. But if I'm wrong, I hope I'm wrong, and the refiners do very well.
Okay. There you go.
That's number 4. Number 4, Netflix. Okay, so Netflix has not actually reported its earnings yet. But today, Disney announced that they were releasing their own streaming service at like $7 a month. Obviously targeted to kids and families. And of course, the first reaction of Netflix is down. Right. They're eating into that. See, I am personally as concerned. I don't want to use the word bearish, but yeah, I am okay. I'm bearish. Look at me. I'll use the word bearish. I just don't think that Netflix is an Amazon. See, Amazon's got a real advantage. But I believe Netflix doesn't have that advantage. And the Disneys and Amazon Primes and all of these are just going to eat away at their business. And I think that this stock is just priced to perfection, and it will not in the end deliver.
Oh, well, that's shocking. You're bearish. I'm surprised.
Listen, I have to have bearish themes.
So listen, when you said squeeze, I thought the squeeze it was going to be headed higher because I wasn't really involved in this one as much, and you were like squeeze. That kind of makes me think higher, and you're arguing. Yeah. I guess you're saying that they squeeze from a business perspective.
Business perspective. Arguing? I just don't think. Look, they're just okay. Fine, they've got some original content coming, and I'm not saying that they won't have subscribers, but like as Amazon Prime and Disney and all of these other competitors come into the space. You know what? I'll tell you the number one sign that Netflix is screwed.
What's that?
My wife canceled our Netflix.
Why?
Because she just didn't want it. She didn't use it. She found her videos and movies on other sites.
I think you guys are outliers. Personally,
no, but no, dude, my wife is like the industry standard. Like she's whenever she like they order shit from Amazon, I know Amazon's gonna go up. Like I can tell just by watching her consumer behavior as to what's next. I was shocked that that even came out of her mouth. I thought that Netflix. I thought I was gonna be paying Netflix for the rest of my life, dude. And
that's actually shocking to me, and I don't know if anything. Our family, we're about to turn off our cable and only go Amazon. We find ourselves every single.
Did you
night
say Amazon or did you mean to say
sorry,
Netflix?
I meant Netflix. I'm sorry. We find ourselves only watching Netflix, and not only that, a lot of the shows are actually Netflix originals. So I don't know. So here's my prediction. Mrs. Big Picture Trading will be renewing her subscription by fall.
Really?
Yep. I think she's wrong. And as much as I like Mrs. Big Picture Trading, I think she's wrong. So there you go. And while we're talking about this, this is a little off topic, but I just want to go a little plug for my favorite show on Netflix right now, Dairy Girls. Like, you can't watch it because you don't have it at home, but outstanding show. You should watch it. It's about Northern Ireland in the 1980s. Probably the best show on TV right now. Just terrific comedy. Anyways, let's go on to number 3.
Number 3. All right.
Oh,
Kev.
This is a good one.
This is your idea. Tell me what's
Yeah. So I saw that, I don't know if it's the CME, the Chicago Mercantile Exchange, or somebody is talking about listing cannabis or weed or marijuana futures. And a lot of guys were saying, remember how that ended
turned out for
crypto
Bitcoin
guys?
Yeah.
Yeah. Because that was the top, man. Like that was once you gave the ability to people to hedge it and to send it down, it was the top. And I don't know if that's correct.
Isn't that amazing that, like, and you know what, like guys like Interactive Brokers wouldn't even, the margin they required for you to take crypto short in the futures was crazy.
Yeah, but they were correct. The exchange had too low of a margin rate on that thing, given the volatility.
I'm dying to see if this happens. Now, now they're only proposing this. This isn't actually coming to fruition, is it?
Right. So now, not that I've ever bought marijuana, but I can tell you one thing that I think it's headed much, much lower.
As a Canadian, you've never bought marijuana, I know.
No, of course not. Canadians, we don't smoke any marijuana. By the way, Google it. Our marijuana use, I believe, is one of the highest in the world. I think High Times called Vancouver one of the greatest places to go, like better than Amsterdam's. Like, it was just unbelievable. So, no, and all kidding aside, it's like, you know, they say wheat is a weed. Well, cannabis is a weed as well. This thing is the commodity itself is only headed one way. It's headed lower and lower and lower.
Sure, it's commoditized, the very term.
And I just think that that them listing a futures contract will be a lot of fun, and I hope they do, because it'll be great putting on the wheat spread or the corn wheat spread. Like, it'll be like kind of funny that way. But I just think
will it be? It won't be listed in the grains. It'll be in the softs, right?
I don't know.
It'll be there with orange juice futures.
Yeah. And Duke trading it. Anyways, I just think that for all you bulls out there, this is not good news. That's all I can say. It's not good news. The fact that they're thinking about listing this thing.
I will short this the moment it goes public, or not public, but when they list this. I think this would be a huge tell. We'll see. All right, number 2. Kev, I just wanted to talk about China here for a second, right? And we're gonna have obviously a great chat in the after hours with Chase about this in terms of China, but we just got yesterday this morning the data, and there was another huge surge in the PBOC pumped another huge amount of social financing into their system. I mean, there's record levels of money, or at least credit, being pumped in by the PBOC into the Chinese economy. And there's different opinions on this. And one thing I've learned from Russell Napier on this is that there's a very big difference between credit and money, and debt money. And essentially, them pumping this in doesn't necessarily have to equate to an increase in money supply, even though the money supply number right here did have a little bit of rise to about 8.6% on this chart. But the question I have here is I wanted to debate this with you. Is this a sign of desperation, that they're all realizing that the situation in China is deteriorating too quickly, and they are just take that needle and inject a huge adrenaline shot into the Chinese economy in a desperate attempt to revive the dying patient, or is this something different? And I wanted your take on this.
Yeah. Well, you've been hanging around with your zero hedge funds again, and you think that this is the end of the world because you see a huge amount of social financing or credit being pumped into the system, and maybe you guys are right. Maybe one of these days they're going to pump this in and nothing's going to happen and the thing's going to collapse in on itself. But in the meantime, I think that you're underestimating their ability to keep it going. And I think every single time you see a central bank pushing in credit, all the bears like to say, look, they know how desperate the situation is. Look at all the credit they're shoving in there. The world is coming to an end. And then they go and they bitch about the fact that it keeps getting levitated. Right. And I find it ironic that those who think that this is the biggest mistake are those that are fighting it the most. Like, Yeah. So if you think that this is
Me
the
and Kyle
biggest
Bass, you mean?
Yeah. Well, I don't. I'm not going to name names, but like if you think this is such a big mistake,
I'm not
that
saying
they're
it's a
gonna
mistake. I'm just trying to understand what's the think about this. This is a huge surge, and more importantly, almost every surge we've ever seen in social financing coming from China seems to be a January effect. If you look at every January, they seem to inject a huge amount of credit. But this is a March injection, and we.
Okay, so wait 1 second. Can I interrupt? So you've given me a chart in nominal terms.
Right.
So
okay, fair enough.
So you're cheating right off the bat because you're giving me a chart in nominal terms. You're saying, look, it's big, and even if you just get an economy growing on a regular basis, every single time it'll be bigger
fair
and
enough.
bigger and bigger.
It's about rate of change. You're absolutely right. No, I'm not going to deny you.
So it's as a percentage of the economy. Is that any bigger? And I bet you it's not as big as it looks. Compared to the other things. Do I think that the Chinese manipulate their system and throw in credit and do stuff? Of course I do. It's China. It's like it's made up numbers. It's crazy. They're doing all sorts of nut bar things and stuff like that. But do I think that this is a sign that you should go out and short everything balls to the wall because you see this?
No. That's not what I tried to imply from it at all. But I think that the big push higher is on the reflation narrative, isn't it? Am I wrong to make that assumption?
What do you mean?
Right now, obviously, oil's going up, everything's going up, but there's this idea here that global, that everyone we heard that just right now from Chase, right? In terms of inflation, so there's this idea that everyone that the deflationists like me were just too early, and that everything is not remotely as deflationary as we just saw, and that there's going to be another surge in this. Am I wrong? Am I putting words in your mouth?
No, but okay. One of the things that I think that you guys are missing from the deflationary side is what is going to stop them from continuing this. So you sit there and go, "Oh God, they're really screwed. Look at how much they pumped into this month." But you might have told me the same thing in March.
I don't think I'm saying that they're screwed. I'm just trying to understand what you're just saying. You're just saying it's not as big because we're looking at things nominally.
I'm not just saying that. I'm also saying I don't view this as you can't go look at this chart and go, oh, therefore they put in all this money. Therefore, I should go short everything because.
And then that's not what I tried to imply, though.
No. Okay. So what are you trying to imply from it?
I'm just trying to more get a sense of what the implications of this are, or whether this is relevant. Look, there's a very clear trend in this money supply growth, right? This chart that we have here, and that's going from the top left to the bottom right. Am I right? Which is that the rate, we went from 20+% rate of money supply growth to the last couple of years, them barely able to keep it. They couldn't keep it double digit. They had to go single digit.
So
there's a trend.
Velocity is following. Velocity of money. And so what the bearish argument is, the velocity of money is falling. So they're taking more and more credit to push into the system to achieve the same goal.
Right.
So whereas before it used to take,
their current account and everything else is dragging on this. The fact that their currency is overvalued and Trump wants it to stay that way, all of these issues are causing structural stresses within the Chinese system that have to ultimately mean revert.
Well, I'm not as convinced as you guys that it's going to mean revert how you think it's going to mean revert. But I do admit that they are having to put larger and larger stimulus to keep it going. And Kyle Bass is bang on correct that it's been a long time since China's had a credit cycle, but it's been a long time since the whole world has had a credit cycle.
And it'll all come to roost. I do believe it. I believe in cycles more than anything else.
Yeah. But this is, I guess, where I come back, and this is my pushback to all the bearish guys. They go, look, the central banks must know something because they're pushing so much into the system. And I'm like, those guys don't know shit. And that's the one thing I completely agree.
They don't know shit. That's going to be the name of the show.
Okay, and because they don't know shit, and that's the end of the day. So when you tell me that the Fed, the ECB, or the Bank of China is pumping all this stimulus into the system, and they see something bearish on the horizon, no. They're desperately trying to keep the balls in the air, and they're going to keep pushing it more and more into the system. And it doesn't mean anything except that they've had to push more into the system.
All right. Well, good argument. Let's watch. I'm very curious how this continues to pan out. So let's move on to number one. And I love this word. It was introduced to me by you, and I love using it now. But did Barron's just goocher it for everyone? So what's on your mind here?
Well, because Barron's came out this weekend and they had is the bull unstoppable, and that's pretty bad for me. You know, I'm bullish and I hate covers like that. David Rosenberg rightly points out the fact that The Economist had a cover where they said something to the effect it was the bull market in everything. And then the next year, every single asset class was down, I believe.
Oh, yeah. They get this wrong every time.
Yeah. Now, some people will argue that Barron's is a specific finance magazine and that it's not quite as good. And really what you want them is on like a Newsweek or like an Economist.
This is still bad.
Yeah, I agree. You know what? I'm not going to couch this any other way. I'm not going to try to make excuses. I wish the Barron's had never written this article. That's like, you know, no, really, honestly.
This really stresses you because this is your cognitive dissonance of just the idea of the fact that, you know, you think that we're about to have this 1998 melt up to the upside, 99 melt up to the upside, and Barron's goochered it for you.
For sure, they did. Listen, when you tell me I'm wrong, it just kind of makes me more confident. When these guys tell me I'm right, I get worried. I love having it, you know, climb the wall of worry, and the last thing I want to see is people agreeing with me. Because by the time they agree with me, there's nobody left to, you know, buy it. Everybody's already long. Yeah. So this really makes me scared, and it's not a good development for the Bulls. I mean. The only good development is the fact that Patrick and his cronies are still short and hanging tough. So let's keep solace in that fact.
All right, let's move on. Okay. All right, so Kev, parting words of wisdom. What would you find for us?
Well, I did this one, and I kind of insisted that I read it out to you because I just want those to know that even though I make fun of the squiggles, and I do make fun of the squiggles a lot. Peter Brandt has a great line where he says, "The world's ocean's floors are cluttered with ships whose captains did not believe in charts." I thought that was just a great line. And Peter Brandt is one of the, I guess, like foremost technicians of our kind of, you know, of the time. He's a commodity trader, and he's on Twitter, and there's lots of great nuggets that he has, and I think that makes a lot of sense. As much as you want, I think Paul Tudor Jones is one of the guys that'll say something to the effect that you can know all you want about fundamentals, but you need technicals to do risk control because you can be wrong, and I think technicals are a way to make sure that when you're wrong, you don't lose too much. And so even though I make fun of you, Patrick, I actually respect, and there's a lot of times I come out of this our little Friday afternoon drinking fest, and I've learned something, and I actually appreciate your technical work. And
you know what? But it's funny is that me and you come from the opposite end, right? Where you're slowly growing appreciation to technicals. Is that that happened to me like 4 or 5 years ago, where I was really starting to appreciate the macro fundamentals. I came into this business the opposite way. I came in as a trader. I came in on the technical side. And I came to realizing throughout my career how important macro was to driving the major trends, and that I needed to know the macro. And that came to my whole narrative, which is that the macro is the center of the universe, and it drives the whole trend. But the technicals bridge an important gap between the macro fundamentals of knowing what is that major trend and when is the major trend happening. And in order to be a very good trader is not only knowing the macro, but being able to identify when the macro is manifesting. And that's where room for technicals come in to combine with macro. And I love that top-down understanding of it. That's the way I look at it.
Well, there you go. A blending of styles. That's how it should be done.
All right. So with that said, let's wrap things up here. So first of all, thank you all, everyone for joining us. I hope you enjoyed the show. Now you can visit our markethuddle.com and sign up for our weekly email that includes the links to the charts that we discussed throughout this. Rest assured that we'll never clog your email with junk. We only will send you the weekly letter and the upcoming shows. You can also follow us on Twitter at the Market Huddle. You have to add the word "the" at the front because someone else beat us to the Market Huddle. It's a Market Huddle. You can also follow Kevin at Kevin Muir and myself at Patrick Ceresna. So thank you everyone for listening. Make sure you subscribe to the show. And any final words there, Kev?
Well, we got a big thanks to Bell City Brewing.
Yes.
We did have a problem. They didn't send me enough.
Yes, you ran out of beer.
I ran out of beer, so I'm going to have to fix
But
this.
The real McCoy.
And it was a great beer. And not only that, we learned a little. Brantford, Ontario, not only the home of Wayne Gretzky, but also Alexander Graham Bell. There you go.
Words.
Stick around. Thanks for sticking. Thanks for lasting this long with us, and stick around for more Chase.
Yeah, cheers.
Okay, thanks for sticking around. We got to talk to Chase about some a little more detail about some things that he's talking about. And Chase, I'm going to start. It's Kevin. I have a client, a big client, a smart client that he's a big believer in, or not believer, but a big kind of China follower. And one day he sent me this email and he said, "You got to read this guy. This guy understands China. He gets it." And do you know whose letter he sent me? He sent me yours. So I just kind of wanted to, I'd like to talk a little bit about your theories about China and what, in terms of the game that they're playing, in terms of, I guess, from a technological point, the fact that we're not in a trade war in the regular sense of the idea, but more in a technological war. So why don't you kind of just go down that road and let's have a discussion about that, because I'm sure our listeners would love to hear it.
Yeah, absolutely. And I think that everyone pays attention to the trade war, and everyone's reading every last word to try and figure out how many soybeans China's going to buy. And I don't pay much attention to that. I know when it comes to actual trade, they'll figure something out. They'll sign it. I just don't think it's going to be that big a deal. But I do think we are in a Cold War with China that's mostly going to revolve around technology. I think the only chance China really has to escape the middle income trap, kind of before their demographics really set in, is to have some major advances in their technology and innovation, and being able to domestically produce a lot of more high value added products. They kind of run out of room to just build more and more stuff. There's only so many railways and high rises and stuff that you can build. So granted, they've kind of exported that excess capacity with the Belt and Road Initiative, which the U.S. kind of seemed like finally figured out that if we try to compete with them on that, it could slow down their ability to hide their excess capacity in the rest of the world. But them trying to fight us on technology is going to be a really big deal for the U.S. and for China. There's a lot of major advancements that are kind of on the cusp in technology, and who gets that stuff right is going to really be able to put themselves in a great position. It's something that I find interesting. I know you've talked about a lot, Kev, is the 2021 100-year anniversary and the next Party Congress in 2022 in China, wanting to go into that looking and feeling good. So I'm sure they will pump some stimulus. But in my opinion, they've reached a point where they're kind of pushing on a string with stimulus, and it would take so much stimulus for them to really pump their economy that I personally don't think they're going to go as hard on that as a lot of people do. And if they do, pump major stimulus, I think that would be them kind of trapping themselves into being a middle income country that kind of just fades into a lost decade the way Japan did, personally.
Wow, I love what he has to say, Kev. That's definitely. I share a lot of your views on that, in terms of the fact that there's only so much China can do on the short term, and I think that this is all an overreaction that we've seen especially even today, when we see the first reactions off of the China data. There's just, in my mind, this is the probability that this is sustainable is just not high. I think that this is just a short-term overshoot that will mean revert to a downtrend that they're in.
Yeah, Chase, you got to remember one thing about Patrick. He's always bearish. He's just always trying to figure out ways that's going to do.
He's got a little bit of that financial justice warrior in him.
Yeah. So, Chase, what does this mean for investors going forward? Like, how do you position yourself if you assume that the Cold War between the U.S. and China is going to get worse going, in the years to come? And am I reading you right that that's what you assume, that this Cold War will increase?
Yeah, absolutely. I think you'll see more and more competition, whether it's with the Belt and Road, with the U.S. trying to kind of compete on that level in some way, or at least trying to stifle them. You'll see, what we've been witnessing with the Huawei kind of aspect of this whole thing. I expect to see more kind of conflicts of that nature, where if China takes the lead in a given area of technology, I expect to see, a significant response to that. But it's important to keep an eye on who is winning from the actual technology standpoint. And when it comes to the trade deal, like, what's going to be super important to look at is not how many soybeans they buy, but what do they actually give up in any way, shape, or form that would limit their ability to win the tech war. And I kind of expect that to be very little, or if there is anything there, for it to have weak enforcement. So getting to the bottom of that when that does come out is going to be important. And then, trying to dig in and figure out who is actually innovating well as we move forward is going to be important. The U.S. has done a lot in the last couple of years to beef up their ability to defend from China coming in and grabbing technology, whether it's through investments or, in Silicon Valley, or just actually stealing data. They have 350,000 college students in America, and a lot of them are STEM students. And a lot of the way those schools go about accepting students is changing because of the government. So kind of just keeping an eye on the way all that's playing out is going to be very important. But from like a bigger macro perspective, I think what's important is China. To me, China's at a really pivotal part where they're about to go crazy with stimulus and ruin their ability to escape the middle income trap, or they're going to keep actually reforming structurally and stimulate, but on a smaller cyclical level. And which of those they choose, to me, is gonna tell you everything you need to know. I think Xi would be happy to actually reform, but I think a lot of the powerful people in the country that have gotten rich and powerful on building high rises and trains, they're not going to give up easily on staying rich by giving that up so that they can build more microchips or whatever.
But how will, like, the actual reform isn't too often their idea of competing on technology, like on a technology basis? Isn't that just, like, as you mentioned, just stealing? So are you arguing, like, so you've given kind of two choices, one being they continue to try to steal and go up the value chain on terms of technology, at which point the U.S. is pushing back hard, or they go back to the old, just kind of build, bridges to nowhere and empty skyscrapers and stuff like that. Right. Isn't there got to be a third option, or is there not? Is that all that we're faced with? Is those two different choices?
I think they're going to have to lean one way or the other, and to me, it'll be obvious which way they go. One of the best ways to watch this is to watch real estate. They've tried to put in some reforms and some caps to keep real estate from becoming a bigger bubble, and they've held more firm on that than I expected them to. But so if they loosen all those real estate reforms back up and just let the bubble go crazy, then in my opinion, they're giving up on trying to really transition their economy, and they're just going back to the old school. But if they go back to the old school, then they're they're destined to be another Soviet Union or Japan, in my opinion.
What do you think about the Kyle Bass theory that they're, one kind of bad, that their foreign exchange reserves are dwindling down and they're about to, be gone and they're going to have to be forced to revalue their currency at 50% haircut from here?
Yeah, I think they need to devalue, but I honestly don't expect it, especially anytime soon. And, the reserve numbers have been doing better lately. I think what this is going to come down to is who's right between Kyle and Luke Groman, because I know Luke thinks eventually they're going to be able to buy some commodities like oil in RMB, which will ease up, that current account pressure. So if they could ever convince Saudi Arabia or somebody to sell them oil and take RMB, that would really give them a lot of breathing room, and then I wouldn't expect to see Kyle's theory come true, at least anytime soon.
Right.
Okay.
So, in terms of just a little bit off topic there, like in terms of macro thinkers out there, who would you say influences your work the most? Like who out there do you really love their macro narratives and the most?
So I've always been a huge fan of Kirill Sokolov. I just enjoy his thinking, and I disagree with him a lot, but a lot of times he just makes me look at things differently. So I respect him.
So for those who don't know, he's the writer of 13D Research. Is that correct?
Yes.
Yeah. So he's outstanding. It's a great piece that it's expensive, right? Like it's tough to get, but he's a great thinker, and it's definitely one of those things that very interesting always to read.
Yeah, anytime I can get my hands on anything he's thinking, I do it. In fact, he wrote a book back in the 80s whenever inflation was running high about how the bond market and inflation was about to end and you should buy bonds. And he crushed that,
Yeah.
So people that can see things like that coming before, and he was a very early investor in Hong Kong and China, made a ton of money doing that. So he sees the big turns, which I like studying people that see the big turns because it's probably the hardest thing to do.
Yeah.
And someone else that I appreciate a lot is a friend of mine, Alex Barrow from Macro Ops. There's so many macro people that I read their work, and it's good and interesting, but it doesn't move the needle on my own thinking. And Alex is someone that somehow always manages to change the way I see things.
Oh, so he has a website here, macro-ops.com.
Mm-hmm.
And which one's the guy that you recommend? Which guy
Alex,
is it?
Alex Barrow.
And how do the people find him? What's if you're interested in watching Alex? Is there Twitter to follow or something?
Yeah, on Twitter he's just Macro Ops, and they have a pretty decent sized team there. He does a lot of their kind of bigger picture macro writing, but they have guys that do some value stuff and a little bit of everything. So sometimes it's hard to tell what work was his and what was theirs, but they write he writes a monthly that's always really good.
Oh, there you go. So when you were talking about Kirill back there and you were talking about the big moves, I couldn't help but think about the fact that Patrick and all these boys are so bearish on kind of inflation, and they always think it's going to go to zero. And I'll have to tell you something. Can we share this, Patrick, about where you were Sunday night? Can we talk about this?
Yeah,
We might as well talk about this. So Patrick got to meet his idol. And he's a really nice guy, but he Russell Napier, which is the king of deflationary, right?
Yeah,
Russell. It's easy to say he's a little bit of a deflationist. Would you not agree?
And rightfully so. He's been right, and he has a lot of reasons to be right. So,
He's a terrific guy, and I met him as well, and he's very good. He's actually Irish. I didn't realize that. I thought he was Scottish. He's a super nice Irish guy, as you'd expect. But I don't know if we need to get Patrick to kind of spend any time with any more deflationists, because it just gets Patrick all excited and makes him all the more negative. It just makes him come in and sell everything.
I will say visiting his library of mistakes is definitely on my bucket list.
Yeah, so he's what is that library? It's something about like the whole course. Well, Patrick, why don't you tell us a little bit about the course and about how it went, and kind of give us a little bit of a little synopsis there.
Oh, I mean, he brought in a bunch of great speakers and teachers that covered everything from historical valuations in the stock markets and what's one of the best ways to actually measure whether or not a market is overvalued or undervalued, and more importantly, what causes it to mean revert. And then he brought in John Greenwood, which is the chief economist at Invesco, and he did a phenomenal job talking about money supply and the impact on the business cycle and all this. It was really good. They got into behavior finance and forecasting in the next 10 years. So lots of really interesting things I'm going to be talking about in the future shows.
So it was just basically all you guys talking about how there's going to be no velocity and there's no money supply growth, so we're going to collapse.
Yeah, but I mean, a guy like, right? Well, listen, a guy like John Greenwood was basically talking about the fact that he thinks we're only mid-cycle, not late cycle, and he actually was forecasting 5% inflation next couple of years. He was actually in a completely different camp than Russell. It's interesting that...
Hey, Patrick, did you throw up in your mouth when
Yeah,
you
I
heard
did,
that?
a little bit. Like, I couldn't believe what I was hearing, this mid-cycle shit. And but anyway, I mean, it's certainly important to always take into consideration, one of the rationale. In fact, I reached out to him afterwards to see, if we can get more out of them in there. But I mean, really the one thing I think I took away from it was they really go back to studying the rate of the change in money supply and as a major influence to inflation expectations, and that no matter how much you can play this commodity cycles and all this stuff, that money supply in the end tells you everything you need to know about the bigger picture trend of inflation expectations. And really the conclusion I took away from it was that there needs to be something introduced that somehow changes the trends in money supply for there to be real inflation. It's not that there can't be inflation, but under the current system and the current trends, it's not a risk, is what I got from it.
Well, I'll tell you one thing. I think that that he's correct. The money supply has to pick up, but I think that's a backward-looking or indicator, and that
it's not a forecaster forward, that's for sure.
No, but I think that when you're looking at commodities, they're already telling you that money supply is picking up. So I think that what you're going to find is the money supply is going to follow what commodities and what risk assets.
Yeah, but I mean, there's going to be bumps on the up. But is it the sustainable one? I mean, look, if oil is heading to $200 a barrel, then that would, I would understand your point. But I mean, if we're now going to approach the top end of the range, then there's going to be a short-term surge in inflation, and then it's just going to the rate of change of inflation will wean right off, and then we're going to be back to where we started. And it was just a 6-month hiccup.
So, Chase, I got to tell you why Patrick was having trouble swallowing your inflation kind of forecast. Because we all know that oil's going right back down to 35 or 25 in the next little while. So, Chase, what do you think the chances tell me where you think oil will be 6 months from now? And I understand you're not an oil sorry, what did you say?
I said higher.
Really?
I think we're at a point in the cycle where it's just
so that December swoon was just noise. It was just a liquidity event.
Yes,
and
I can explain it.
All right.
Yeah, the Saudi Arabia just absolutely flooded the U.S. with oil during that time, and it kind of for whatever reason, no one cares about global oil supplies. Everyone just cares about U.S. supplies whenever it comes to the price of WTI, and so it's pretty easy to move the price down. You flood America with oil, and everyone goes, "Oh my God, look at those, look at those inventories."
Hallelujah, Chase, you are I completely agree. People don't look at the worldwide kind of inventories. They're all focused on WTI or U.S. inventories, and they don't understand that it's a worldwide commodity. I 100% agree with you.
And the Saudis did that seemingly as a favor to Trump because he was wanting them to get the price down so much. So they chose to do it that way. And then naturally he kind of turned his back on him with the Iran sanction waivers. And then, I think that probably really upset them. And, lately they've been starving the U.S. out of oil, and it's starting to show a little bit in inventories, even though
So,
they haven't drawn down significantly, but.
Yeah, so I have a question for you. With the recent floating of the Saudi Aramco bond, the long-term debt, they've had to release their finances, and you see that one of the things that was kind of released was the reserves of, or not the reserves, the production of the different fields. And a lot of people are talking about the fact that Gawar, which is the world's biggest kind of discovery of oil ever.
Kev, you got to just rewind, because just start from the beginning, please.
What happened?
You chimed out for a second.
You dropped out.
Yeah, if you could just start for that, your little bit from the beginning there.
Okay. So where did I chime out from?
Just the sentence that you had started.
Just share your thought from the start.
Okay. You better mark down the time.
Yeah, I got it.
Okay. So, Chase, I couldn't agree with you more. And one of the things that I find extremely interesting is the fact that with Saudi Aramco recently floating that long-term debt issue, they've had to release some of their finances or some of their financials in terms of the different productions of various fields. And I noticed that some of the kind of more astute crude oil watchers have noticed that Gawar, which is one of the world's, or I guess it is the world's biggest kind of reserve, has not been kind of performing like everyone thought it had been performing. And I have a buddy that's a really smart guy that has been in the markets forever. And we were out for dinner the other day, and he told me that he's as bullish on oil as he's ever been in his life. Wow. And I was like, really? I was like, wow, really? And he says, yeah, they've just admitted to you that this whole Matt Simmons Twilight in the Desert is happening. And I said, oh, well, that's funny, because all of the kind of fast money guys are short oil, and they all think it's going down. And he says, all the better. And he's a long-term kind of fundamental guy, and he's convinced that oil is headed to the moon, and that basically this Gawar thing is a much bigger deal than the market is realizing. What do you think, Chase? Have you looked into it?
I have, and I totally agree. I mean, when the biggest oil field in the world is producing a lot less than everyone thought, it's obviously a big deal. It sounds like a great time to monetize your giant state oil company, doesn't it?
Yeah, that's right. Yeah.
And and on top of that, you look at U.S. shale and how just unprofitable it is, and how fast the decline rates are moving there. To me, there's a lot of different reasons to be bullish oil. I think if you look at the S curve and the middle class in Asia, where you're just having a huge explosion of people entering the middle class in Asia that are going to start consuming more energy. I just think there's drivers on the supply and the demand side for the next couple of years that, I don't know, make a lot of sense to me.
Yeah. So Chase, again, you're speaking my language. We're Canadians, so we call it the hockey stick curve. And on the demand side, if you look at kind of developing nations, and if you go back to Japan coming out of World War II, and you look at the energy use per person as they kind of got more and more wealthy, what happens is it ticks up bit by bit by bit, and then it just explodes higher. Like there's the kind of the bottom of the stick, and then it starts going straight up. Same thing happened in Korea. It started going up a bit, and then boom. So it's the exact same graph: Japan, Korea, and now we're finally entering it into China. But the thing about China is that they are so much bigger than either of those economies at that stage. So I think everyone's focused on the supply side, not thinking about the demand side and looking at that. And I agree. I think that people should be looking at oil from kind of a long-term perspective as one of the cheap assets out there. The other thing about
I'm just gonna take the other side of that.
Yeah, of course you are. Of course you are.
I am. But you know what though, where I'll give you guys something is that I do actually. Think there will be a huge oil bull market on the other side of the business cycle, but I just think that you guys are talking a story that can manifest itself over a much longer time horizon, like 3 to 5 years, and may not be as big of a deal in the next 6 months to a year. That's my opinion.
Well, Chase, I have a question for you.
I agree with that.
So I have a question for you, Chase. I saw the other day, I think it was Jared Dillian from the Dirt Nap fame talking about how some of the best performing stocks have been like sin stocks. I think it was him that was arguing this. And he said that, in essence, oil stocks have become a sin stock. Right? And with the millennials, and you're kind of like one of the, I guess you're an early millennial, I would guess. But like, if you, amongst your friends, if you told them you were long like oil stocks, would that be viewed as something that's like, ooh, like when you're trying to pick some girl up, you know, you don't want to tell her that?
I've never really thought of that. I would say the people I hang out with wouldn't look at it that way. But I think if you just did a cross section of, especially the younger millennials, I do think it might fit into the sort of the sin area. They've just been raised, you know, kind of to view fossil fuels as bad no matter what. I mean, they even think nuclear is bad, which blows my mind. But
yeah, like we're gonna all make it on kumbayas, and like there's gonna be, that's how we're gonna pay, like kumbayas, and Elon Musk, he's gonna save the world with all of his battery power, which gets, like, interestingly enough, in California, isn't the majority of electricity created through coal burning? Am I wrong?
I have no idea.
I think it is, though. Like, it's a shocking
there is
amount.
A lot of solar and wind, I know, but
it's I don't think it's increasing all the time. But you know, I'm going to get in trouble from all the millennials that are listening and stuff. But I really think that if you're an investor and you're thinking about the idea of energy stocks, I really believe that there's a chance that they have become the tobacco stocks of our generation. I think Jared Dillion's on to something when he talks about that. And so everyone's wondering why they haven't rallied with oil. And I think they haven't rallied with oil because nobody wants to admit they're long.
You know what? Then I have to admit that I'm a sinner.
We know that.
One thing I will note that is super interesting in energy stocks is if you look at the ETF OIH versus XLE, it is mind blowing how beaten down like the services companies have been compared to.
So here's the OIH, and one second. And what you want me to compare that? And I compare that to which one?
To XLE. XLE.
The main.
You know what's interesting is, so I went out with dinner with these fellows that were they're older than me. They're boomers, and they're kind of wise, shrewd. I don't know how to describe them. Vancouver, kind of
pulling like on a monthly.
Yeah.
Sorry.
I'll actually just do a.
So I went out with these guys, and they're kind of shrewd operators, and they were all buying the oil service companies. So I tend to think that the smart money is buying that.
Well, you know what? Like
I find myself. Go ahead.
Yeah, myself am messing around with the Schlumbergers of the world. They've been the dogs, like Halliburton's and Schlumbergers. They just simply can't get. Even though surprisingly the refiners simply are dogging it too. I mean, it's really the Chevrons and Exxons that have been ripping on the upside, and a lot of these periphery ones just can't catch the bid.
Yeah, absolutely. And for me, like I don't really like shale. I'm pretty bearish on shale, so I was trying to find ways to get into the oil stocks without being super exposed to shale, and that's kind of why I started looking at the services companies.
Yeah.
I mean, granted, obviously they're tied to shale in their own way, but
yeah. Well, listen,
I really like offshore.
I like your idea. I mean, that makes a lot of sense on that regard. Do you like the refiners?
Not as much as the. My favorite exposure is anything I can get offshore. So the companies that are out there, Transocean, and I do like Schlumberger as well. Like some of those services guys, I just think they're going to do better than pretty much than the refiners,
right.
and the big oil companies, because all the big companies, it seems like, have gone into the Permian and started lighting money on fire for whatever reason.
Right.
To me, that's a giant riddle, is why the majors have gone in to shale where they're not making much money or any money at all. It's weird to me.
Yeah, so here's Transocean. Yeah, the chart there. Yeah, it looks a lot like the oil service stocks. It just they haven't caught on at all.
Mm-hmm.
So Chase, what else do you like? What other kind of trade ideas are catching your eye?
So I'm a huge uranium bull and have been for like 3 years. You know, we haven't seen much traction on that. Hopefully the Section 232 comes in soon, and that hopefully becomes a catalyst for the sector to start picking up.
This is gonna be a uranium kumbaya between the three of us here, because
yes, we all agree on this one.
Patrick, you don't like uranium?
Oh,
too,
yes,
do you?
I do. I've
God.
this is bad. This
okay,
is
so
really bad.
Chase, what's your favorite way to play
Everyone
it?
should definitely short sell all
Yeah,
those.
exactly.
What's your favorite way to play it, Chase? What are you doing? Like, how are you expressing that view?
I combine calls on Cameco with I have Energy Fuels and UR Energy are my kind of two favorite plays right now.
Yeah.
Like the frustrating thing is the fact that CCJ is like really Cameco's the only way you can really get options.
Yeah, exactly.
And the futures contract, everyone said it was a liquid, and I tried to trade it, and a liquid doesn't describe it. It doesn't move. So I wish you could trade futures on it.
Yeah.
So I'll tell you something that people, for those that are more sophisticated, and before I say anything more, I just got to tell everyone that I am long this bond. It's one of my bigger holdings. Energy Fuels has a convertible, and it's only for Canadians. It's listed in Canada, but it's convertible, and so what you get is it's kind of. The bond is such a small part of the market capitalization of the whole stock that it ends up being that there's the credit portion of it is going to be good. It's a 2020 and it's a convertible. And let me just pull up the details. It's 8.5 coupon.
So this is the convertible for the Energy Fuels, which is that UUUU?
Yeah, that's correct. It's EFR in Canada because we have a different symbol. But it's an 8.5 coupon in December 31st, 2020. And it's, I think it's one of the better ways to play it because to me, I think from the credit portion standpoint, it's money good. And then what you get is the opportunity if something really good happens to take advantage of it. So it's convertible at a price of, where are we here? I'm just trying to kind of.
We're at 439 right now on the stock.
Right. And it's convertible at 415. So it's at the money.
Yeah.
So to me, I just think it's super illiquid. So don't run out and kind of just pay up for it. But it's
don't
one
go
of those
Scorpio
things,
on it.
Yeah, but it's one of those things that if you're looking for, and if you're sophisticated enough to kind of trade a convertible bond, you should have a look at it because it's, on down days, it's something that you should be looking at buying because I think it's a great purchase.
Kind of.
So what else do you like?
Days.
Yeah, it is. It has had a couple ugly days, but it's that's just that. That's the way that the thing trades. It's very liquid. Yeah. It doesn't. It makes no rhyme or reason to what the movements. And you guys can put all your squiggles on it, what you want. It just if someone comes in and sells it, it goes down a lot. And someone comes in and buys it, it's going to be one of those things that it just resolves itself, hopefully higher. One of the things that a lot of people play is the U, which is the Uranium Participation Unit. Yeah. Which is an ETF, and you can buy that thing. And the interesting thing about buying it's a closed-end fund on uranium, is that you're buying a commodity that is trading below the cost of production. And not only that, the spot is trading significantly below where long-term contracts are being executed.
So it's you don't have that burn.
Yeah, so hopefully it should be decaying upwards, but it doesn't look like it is lately. And as Chase noted, it's been kind of a frustrated. It just hasn't gone. So, just for those who don't know, 232 is what a bill proposed by EFR actually, or Energy Fuels, for the President Trump to stop selling all of their excess uranium and make sure that they're buying a certain amount from local domestic suppliers. Is that correct? Chase, are you familiar with the specifics of the bill?
I think it's just going to be another one of those. I don't think they really spell out the prescription on what to do. I think that's kind of still up in the air. And I know a lot of people are actually worried about what they'll do with that, whether it's quotas or something different. But it's one of those, is it a threat to national security questions? And the way I see it, if automobiles are, then surely the fact that Russia controls so much of our uranium needs, I would say, is probably a threat to national security. So I would assume it's going to go through. But I don't think anyone knows what the administration would do about it if it does go through.
Right. So for those who
for
those who haven't followed it, is that for the longest time, there was all these nuclear warheads that were getting dismantled, and then they were getting sold off into the market. And that's part of the reason that uranium has been in such a terrible bear market, is that all of that fuel had been kind of converted from nuclear warheads into fuel for uranium reactors. And in doing so, it's made it so that there's not that many mines out there, and that if all of a sudden Russia could actually controls the supply of uranium between, I believe, Cameco and Russia. I think that's the majority, even more than majority of the supply. And given how the United States has been treating Canada lately, you can't even rely on us. And so I think the Americans are kind of waking up to the fact that this isn't a good idea, and that they should kind of secure their own nuclear stockpile. And so that's one of the things about EFR, Energy Fuels, that's so attractive, is that it's one of the few kind of American projects. Is that, like, if I got it right? Like, is that basically it?
Yeah, exactly. And that's why, like, UR Energy and Energy Fuels are two of the, they produce in the United States, and it's 20% of the U.S. grid is nuclear power, and yet we produce almost no uranium. Wow. So clearly an issue. Right. So the U.S. producers should, theoretically get a nice boost if there is some sort of price control put on, or production control.
Yeah.
All right.
Okay. So what else do you like? Do you have? Oh, sorry. Go ahead, Pat.
No, Patrick? I was just going to ask you, Chase. Is there a fun story behind the name of your newsletter, the Pine Cone, or is it just a name that you just liked?
So no, it actually goes back to Mark Spitznagel wrote a book called The Tao of Capital, and in that book he uses a lot of metaphors to talk about the economy, and whether it's martial arts or war. One of them, he talks about coniferous forests, and he talks about the strategy of the pine cone, and it gets really deep into how pine cones won't open if it's wet outside because they can't spread their seeds. If it's not windy, they can't spread their seeds. They won't open. Some pine cones, like the jack pine, it actually won't even open its pine cones unless it's in a forest fire where it's like 2,000 degrees. And the reason it won't do that is they compete against deciduous trees for territory, essentially. So they kind of sit back and wait for a major disaster that kills their competitors, and then they go in and spread and take their territory over. And the book goes on with different levels of strategy that pine trees or pine cones kind of seemingly implement. Obviously they don't. Actually, they're not thinking about it, but I just found the kind of the strategy in a pine cone to be just really useful as a way to think about markets.
Well, I'm glad I asked this question, because this is fascinating to me.
It's great. I had no idea.
This.
Yeah, so I wrote a free letter for a long time called the White Mountain Letter, and every one of those letters I would talk about a different pine tree and get into what made it significant in these different kind of analogous ways. So yeah, those are actually, I find them interesting.
So Chase, I didn't know you're a big tree guy. What's your favorite pine tree then? You better say the white pine, because that's what most of Canada is filled with.
Douglas fir. So what's the story there?
Indeed. So I wrote about this a little bit. It kind of does something called morphological plasticity.
Yeah.
And I'm sure you guys have heard of, like neurological plasticity is kind of the ability to adapt. And you think about trees and evolution, you think they probably adapt over, millions of years, and that's true. But like a Douglas fir can actually adapt almost near real time to its environment. There's some of them that grow almost as like shrubs, in like more desert-like areas, and there's some that grow really, really high on the coast of Washington. So their ability to do that, I found to be really interesting, and I kind of wrote about how, as a trader, you have to have that same sort of plasticity.
That's awesome.
That's terrific. Have you gone to the redwoods, by the way, while we're talking trees, or the sequoia?
Yeah. So I live in Southern California now, but I lived in Northern California for years and got to spend some time, especially the coastal redwoods, the Avenue of the Giants, which has a lot of just massive trees. So and I've written about them as well. They're pretty crazy.
I took my family up there, and it was one of the greatest trips we've ever done. Like, it's outstanding, and I would highly recommend it. And actually, my wife's going back, and she's going to go to the sequoia, because the sequoia is a little more inland. The redwoods go right on the coast. And have I got that right? Yeah, I think I've got that right. The sequoia, the redwoods are more on the coast, and the sequoias are more inland. So she's going to go look at the sequoias. And I believe the sequoia is the biggest tree, but the redwood is the tallest. Is that right? Like you seem to be much more.
Right, yeah.
You sound like a much more of a tree expert. But till you go there and get an idea of the size, it's mind blowing. And then the fact that they went and just cleaned all those trees out. And if you're in San Francisco, you basically have to drive 5 hours north. You have to drive far enough that they couldn't haul the logs back. like that was it, because these trees are 300, 400, 500 years old, or even older, I believe, at times. So you have to go kind of so far north that they wasn't economical for them to kind of cut them down and bring them into San Francisco. So it's just fascinating.
Yeah, and the Muir Woods actually is right outside of San Francisco, named after your namesake there, John Muir, and you can see some redwoods that are actually kind of close. Pretty small forest, but it's a really cool place.
Yeah, I was joking with Brent Johnson the other day because someone asked the favorite underrated movies, and he said Spy Game. And I told him that was the second coolest Muir out there, and that was because Nathan Muir was the character, Robert Redford's character in Spy Game. And I said, and the number one is, and I said, it's not me, it's John Muir. And so I can always tell somebody that's grown up out west, because some people have trouble with my name, but for those that have kind of been around San Francisco, they all know John Muir because of Muir Woods, and it's all of a sudden. Exactly. They asked me if I'm related to him, and unfortunately, Muir is not that uncommon a name in Scotland, even though it's uncommon.
Yeah, and speaking of Brent, Brent's a good friend of mine, and he, you asked about macro thinkers earlier, and I think everyone thinks of him as a gold guy, but I really think that Brent is a really good macro thinker and a very original macro thinker.
Yeah, he was one of the first guests on the Market Huddle. And I had a chance to meet him out when I was in San Francisco a couple of times. So out in Vancouver. So he's a super guy. I'll vouch for that.
Super nice guy. Although we are kind of worried as gold bulls, or not worried. We're kind of excited about the fact that he's closed his gold fund.
He's called the bottom on gold.
He's called the bottom on gold. He's closed his gold fund and given up on it. So we're kind of as long-suffering gold bulls, we kind of view that as a positive development.
Yeah,
Brent,
if Eric Townsend gets long oil, I'm done.
Okay, Patrick will quietly be just no comment to that thing, but and he didn't laugh, but I did. Okay, that's a great line, buddy. Okay, well, Chase, thanks for spending some time with us. Why don't you just kind of in following up, why don't we tell everyone one last time where they can find you? Give us the Twitter handle and the website.
Yep. Twitter handle is @PineConeMacro, and the website is pineconemacro.com. And then if anyone wants to read the letter, my weekly is called The Cascade, and there's a Pinecone Macro research tab on the site. That's how you can get to that to sign up for it.
Well, that's terrific. Thanks a lot. It was great having you on.
Thanks a lot, Chase.
Yeah.
Take
Pleasure,
care.
guys. Thanks for having me on.
Okay, see you later, bud. Bye.